There are a lot of tailwinds supporting the economy for next year.
You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem.
One of the key themes that we've noted for this year is people really underpricing kind of the macro risk.
We still have a problem with inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Traders looking for this year to end as AI worries overwhelm enthusiasm. Stocks firmly in the red now for the month after 4 straight days of losses, looking for glimmers of optimism, whether from fiscal stimulus and central banks with the Bank of England and ECB on deck, and the state of the U.S. economy in focus as we await the first inflation read since September. Danny Berger alongside me for the next few hours. Danny, to me, this really is going to be the key tell, especially after what we heard from the president. CPI and jobless claims very much on deck.
It's a big day, but when you talk to people or even look at what's priced in to this options market, it's a shrug. It's outdated. Do we care? I think we have to care. Considering what we heard from the president, to your point, considering we're likely to get more cuts from this central bank, that is dual stimulus. How in that world can we get inflation back to 2%?
Yeah, are we in an economy where the labor market needs to be more in focus or inflation needs to be more in focus? Joining us for the rest of the hour, I'm so pleased to say, is ADP Chief Economist Neela Richardson. Neela, to what extent have we seen the market move on from inflation without the inflation data to justify that type of sentiment?
Today may pull it back to inflation. We'll see. But I think has been a head shift to the labor market, rightly so, in my opinion. But the labor market is really the source of two things. It's the source of growth because the consumer is real well anchored to the labor market, but it also is the source of that maybe secondary rate cut that they're looking for early next year. So they're looking for two different things coming out of the labor market, but the inflation data today may change that story.
And it would be the first inflation read since September, and we aren't going to get month-over-month inflation reads because guess what? The government was shut down and we don't have that comp. In the meantime, looking for optimism, getting a little bit of a lift from Micron shares after they reported earnings that had a very different tone than what we saw from the likes of Broadcom or Oracle, talking about how demand is just so far outstripping supplies that essentially they can raise prices, which is why you're seeing those shares up almost 11%, a massive beat. Can this turn around some of the AI sentiment?
It speaks to just the narrative whiplash that we've had on AI, that one day we're worried about data center fundings and the next day there are shortages when it comes to chips. If anything, though, Micron just highlights it's still the picks and shovel trade, which is working so well. We've really tried to broaden out, be it with the hyperscalers, be it with maybe software plays that can benefit. That has been really volatile. What has worked are these companies who are saying there is still a shortage and prices are elastic because of that. So we're going to bring in a whole lot of cash.
So how much comfort can we get from this? Right now in markets, we do see a little bit of a lift. Futures higher. Let's try this again to snap a 4-day losing streak. Although we did this yesterday and we did this the day before, up 0.4% ahead of the open on S&P futures. That euro-dollar cross 117. And you do see yields markedly inward. Maybe this will give some people a feeling of confidence as they await that sort of push-pull between jobs and inflation. 10-year yields at 4.13%. Coming up this hour, Beata Manthe of Citigroup as stocks look to find their footing. Henrietta Trey's of Veda Partners as President Trump defends the U.S. economy. And Terry Wiseman of Macquarie with a trio of global central bank decisions ahead. We begin this hour, stocks trying to climb higher as investors await the latest inflation data. Beata Manthe of Citigroup remaining constructive on equities in 2026, but writing volatility could remain elevated amid continued reassessment of the AI theme, cracks in the United States soft landing, and demanding valuations, which could cap upside. Beata joins us now. Beata, thank you so much for being with us. There was a new survey from Deutsche Bank talking about the risks ahead into 2026. The overwhelming consensus is that AI valuations and a potential popping of some of those elevated expectations is the biggest risk heading into next year. Do you agree?
Good morning. There are many risks, but as you've read out in our report, it is on the top of our risk list, definitely. What high valuations make to stock market prices, they make them more volatile and more vulnerable to any news flow. And as you've discussed before, the news flow on the AI story will remain volatile as well. So it's going to be a fight between good and bad news.
At this point, this is a reason why I think some people are saying, okay, what are we missing? Because ultimately, if there is such a consensus in one thing, that usually makes people nervous. What is the thing people are not watching that could be a major market driver in 2026, whether it's a shift away from AI, whether it's a shift away from the United States?
So our view is that consensus is for over delivery of earnings, and that's how the market is priced in. So we have that model that is trying to capture what kind of EPS outlook is priced in by the stock market. And I have to say, across all the major markets around the world, all the equity indices are priced for over delivery of earnings. So the pressure is on for earnings not only to deliver according to analyst forecasts. Actually, the expectation is for them to go higher.
Not just earnings, Beata, but what about margins? There were two stories yesterday. One, General Mills saying that they were lowering the price of products among 2/3 of their products in North America. Then there was Lennar, the home builder, saying that they've had to cut costs and offer incentives to get Americans to buy housing too. Beata, are we going to start to see some serious margin pressure materialize next year?
We haven't seen too much happening yet. And where I sit in Europe, actually, in the year when tariffs have hit, we actually have not seen too many margin pressures yet. Where it could come from, of course, is the issue of the tariffs on the US companies. So the scare, the fear beforehand has been that we would have double whammy here in Europe through strong effects and also tariff hit, i.e. exporters paying for tariffs. Now we know, it's evident in the data, that tariffs are being paid by the importer side. And for now, 70% of these tariffs in the US is paid by the corporate side and 30% for the consumer. So if that continues on certain level, certain parts of the equity market, you could have some margin pressures. But overall, when you, and I'm quoting here our US strategist, Scott Croner, when you look at the composition of S&P, the margin, the companies that could have margin pressures are not the majority, and they are not the huge market caps, right?
And this comes back to AI, right, Beata? Because that's what's been driving this market. But their business models have also changed. They're not asset light anymore. They're taking out a lot of debt. Their cash flow has been substantially lowered. And in the case of Oracle, it's turned into a cash burn. Should these big tech companies get the same valuations? If you are analyzing high valuations, the justification came from the fact that they were asset light. Do we need to completely rethink how we model out the valuations and earnings of these companies?
You could have arguments for both ways. That the valuations are too high, they should come down, but because of the arguments that you've just enumerated. However, an argument for continuation of seeing high valuations could be the fact that actually, when you look at valuations, what do they have in them? They only have 12 months forward EPS, right? For these mega themes, structural or themes like AI, perhaps it is justifiable to price in more than just 12 months forward EPS, and actually it should be, right?
Good morning. With AI being a huge driver of the equities globally, how important is the consumer and the consumer resilience going into 2026 in your outlook for the markets?
It is always very important. And of course, in the US, you could have some pressures. So our view is, the view of our economists is that there is more softness in the labor market in the US that it's seen at the top level. This is why our economists have 2 consecutive cuts coming into the next year out of the Fed. When it comes to the consumer elsewhere in the world, in Europe, for example, where I sit, the consumer has been weaker and subdued. However, we have huge amount of savings in the bank accounts right now. Now, there'll be different drivers of the economic activity in different parts of the world. In Europe, actually, Europe is becoming, the growth in Europe is becoming more investment driven. So we have a huge fiscal stimulus going on. That's going to drive the growth, perhaps not so much consumer itself in the first line. It's more the government investments, and then consumer could come along later on. So very different drivers of growth between different parts of the world, I would say. But overall, still resilient growth when you add it all together.
Beata Manthi of Citigroup, thank you so much. And Beata is talking about the potential for fiscal stimulus over in Europe when Germany announced that will increase federal debt sales by a fifth next year to about $601 billion. So it just highlights how the drivers of growth are changing. In the United States, it's both the consumer being strong, but also this idea that we might get fiscal, as we heard last night, 1776, as well as potentially monetary policy easing. How much, does that really support the outlook for the consumer, Neil, at a time where the real existential questions about the fundamental labor market?
Enter a new actor in 2026, fiscal spending. We saw fiscal contraction in 2025, especially with all the DOGE cuts. Imagine investment not only in the U.S., but in Europe, in which it leads to more hiring, more capital spending. It could be quite stimulative. And we have the infrastructure projects in need of that kind of investment, not just AI, but physical infrastructure. So it could lead to a boom in some ways.
I think the fly in the ointment in that, though, is does the bond market finally start caring again? Scott Lincecum of Cato Institute pointed out that with the most recent checks that Trump wants to issue that he talked about last night to military families, that's the 10th thing he said that he would fund with tariffs. This is a market that started to treat tariffs as something that can help the deficit. What happens if you get that fiscal spending and it's taken at the cost of the money that supposedly is coming in? And if the bond market starts to care, does that just tighten conditions and act against everything that they're trying to do?
Frankly, we've seen this already, right? The idea of a steepening yield curve. Some people say that it's just beginning. And this is the reason why, even if the Fed cuts rates significantly, it's not necessarily going to be that stimulative just because you are not seeing long-term yields go down in the same kind of way. We're going to get to that in just a second, in particular with that 1776 10th thing, as Scott Lincecum said, that has been promised with tariff checks. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. Calls are growing for the EU to approve a massive loan to Ukraine backed by frozen Russian assets without the support of Belgium. Kyiv's finances are likely to run out in a matter of months without the boost. Meanwhile, U.S. and Russian officials are set to meet in Miami this weekend for continuing talks on a peace plan. Meanwhile, Micron shares are jumping more than 11% in the pre-market after blowing past estimates for the first quarter and posting better than expected revenue guidance. The semiconductor manufacturer is expecting second quarter earnings to be nearly 80% higher than consensus estimates as the firm benefits from the relentless demand for memory chips used in data centers. And oil giant BP has appointed Meg O'Neill as its next CEO. O'Neill comes to the company as an outsider, leaving Woodside Energy Group after previously working at ExxonMobil for 2 decades. She's the first female CEO for any big oil company and replaces Murray Auchincloss, who served in the role for just 2 years. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, President Trump's economy.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history.
Henrietta Trey's of Veda Partners joined us next as we look to that speech. What could potentially get fulfilled in the increasing slate of promises? This is Bloomberg Surveillance. This is supposed to be a happy time of month where all stocks gain and everybody feels good as they go off to vacation. We're not seeing that. We've had 4 straight days of losses. The losses are mounting for the month, almost down to a decline of 3% for the NASDAQ. This morning, we're going to try again to turn that around, up about 0.5% on S&P futures. The euro-dollar cross is seeing a bit of stellar strength coming back into play, but still around that 117 level, and yields in about 2 basis points with the 10-year at 4.13%. Take a look at Micron shares trading in the pre-market. This idea of how much guidance can make a different kind of picture for different tech giants. Broadcom, Oracle, the shares fell after their earnings. Micron shares up 11.3% after this comment from a senior executive. This is the most significant disconnect, Annie, between demand and supply in terms of magnitude as well as time horizon that we've experienced in my 25 years in the industry.
So all those people in that Deutsche Bank survey that were worried about AI being overhyped as the biggest risk for 2026, here's evidence that it's not, that there is so much demand that there is shortage. An interesting turn to this, I think the Wall Street Journal laid it out this morning, that, we talk about the competition for energy assets. This is competition for memory chips. These are also things that go in smartphones and PCs. The threat could be that because all of that is getting routed to AI data spend, what if consumers have to pay more for PCs or smartphones just because of the prices that Micron can now command?
Yeah, they're different bubbles, and they're different ones inflating at different times, and maybe you need to pay attention to which one is the most pernicious. Under surveillance this morning, the focus turns very much to Washington, D.C., President Trump's economy.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Here's the latest. President Trump defending his economic record as he looks to reassure Americans about the rising cost of living. Recent polls showing his approval rating slipping near the lowest level of his second term. Bloomberg's Tyler Kendall joins us now. Tyler, what did we learn yesterday, and how much can some of these proposals come to fruition in the near term?
Yeah, hey, Lisa, good morning. Well, perhaps we learned that the White House has really been trying to go on defense when it comes to the issue of affordability, and this does come at a pretty critical time considering that we're about to head in to the midterms last year. Now, as you heard, we heard pretty consistent messaging from the president last night, including that Americans should be feeling better about the economy. Yet at the same time, it also appeared that he was seeking to reassure that the full impacts of his economic policies haven't really kicked in yet, right? We heard him say that the U.S. is poised for an economic boom. He also said that the benefits from the One Big Beautiful Bill haven't fully been baked in, that we'll see that next year. And he also, of course, pointed to a new Fed chair he says will lower rates. Now, one of the biggest new policies announced was that warrior dividend check you heard the president talk about there, that he says will be coming in a matter of weeks and is funded through tariff revenue. The thing is, we didn't really get a lot of other new policy proposals from this White House last night. It really was recounting a lot of what we've seen from this past year. So it's going to be something to really watch closely, including what could be rolled out. The president did preview that we'll get aggressive housing reforms. In his words, that's important because on the campaign trail, he did campaign pretty heavily on the idea of deregulation. And there is reporting that we could see some enhanced housing entitlements for U.S. service members. Lisa, at this point, we were expecting that we could get more when it comes to health care. Of course, the issue that's been dominating the conversation here in Washington. President Trump did outline his opposition to extending the Affordable Care Act premium tax subsidies, saying that this would be a way to lessen the money going to insurance companies, but he didn't ultimately endorse any of the plans that are brewing on Capitol Hill.
Tyler Kendall, thank you so much, as always, for that. Neela Richardson with us for the hour. Neela, what did you make of some of these proposals, given the fact that there is a focus on supporting the labor market, but it's unclear how quickly some of this could really come into play?
Yeah, it's interesting whether or not these proposals come through the consumer or come through business, because they have very different effects. Some of them are quite transitory. If you think about a paycheck, maybe it goes to savings, maybe it goes to a down payment. But when you think about like the AI tech workforce, I mean, investing in skills and technology for people who can create this AI infrastructure and echo chamber that we need to produce productivity is really, really important. So I think there is a whole spectrum. Some of them are really important for the labor market and the future of AI. Some of them could be gone in a moment.
Which raises a question, how much is this throwing spaghetti at the wall and how much is this truly laying out a potential plan from the president? Joining us now, Henrietta Trey's Director of Economic Policy Research at Veda Partners. Henrietta, what was your take from the announcement, the speech last night?
Well, it definitely wasn't about the Christmas decorations. 90% of Americans, according to the latest Fox poll, believe that inflation is the biggest problem facing them. And what's a little bit off-putting is that the president touted a lot of data sets that just are not resonating with American voters or factually accurate. So anybody who's turned on the news this year has seen AI and data centers driving electricity prices up 13% for residential electricity prices nationwide on average. You know, if you tell me that the cost of drugs is dropping by 400%, 500%, 600%, which is what the president said last night, that means you're paying me to take drugs. And you don't have to be that good at math to know that that's not how drugs work. And finally, I would say the $18 trillion investment that he touted from the trade wars that he's launched and the deals that he's reached is outrageous. I mean, this is like China's entire GDP. So you need to put some things in context that American voters can actually take with them to the grocery store. And that's not what we got last night.
Henrietta, just that point, I mentioned this before, that Scott Lincicome of Cato Institute was talking about the fact that this is the 10th thing that Trump has promised to fund with tariffs. I'm going to be honest, ChatGPT helped me with this list, but I was just looking at some of the things that were promised. The military checks, tariff dividend, farm aid and targeted bailouts, child care, social programs, tax cuts or elimination of income tax, foreign or industrial subsidy funds. Henrietta, I know a lot of those are a wish list, to Lisa's point, versus actual policy. But what happens if he does try to fund some of these with the tariff income? Is that even possible with the amount of money coming in?
I mean, first off, find me the votes. If you can find me 51 votes in the United States Senate for a $450 billion, $2,000 check to the American public, I would love to see it. I can't count you the votes. I can't get you a reconciliation bill. I can't even get you a budget for fiscal year 2026. So the idea of even getting these things through is not realistic. And then the bond market, of course, is counting on this, what CBO estimates is $3 trillion in revenue brought in by these tariffs over a decade. And we've already spent it. We've more than spent it. It's only been $89 billion brought in by the IEEPA tariffs going back to October. So, I mean, the money is just not there, and the votes aren't there either.
Henrietta, it's a great point. I also want to get back to one of the other things you just mentioned, too, this idea of the consumer feeling also the affordability pain of what's happening with their electricity prices. We saw the Blue Owl and Oracle deal. Part of the reason it crumbled was because of the politics in Michigan of lawmakers pushing back against tax subsidies. Earlier in the week, we also heard from Bernie Sanders saying that there needs to be a moratorium on building on data centers, partially because of what you're describing with the prices. Is it likely, as affordability becomes a bigger issue, that lawmakers will really start to push back against some of the data center construction and spending that is happening in America?
Yeah, you can see it all over the place in terms of physical pushback. AOC had some tweets about it yesterday. I saw it's definitely a popular talking point. There's not going to be any legislation to prevent it. So this would have to be active, boots on the ground, district led, sort of protests against the construction of new data centers. And they're going to have to conflict that with the job creation, which in many of these cases is the only job creation that you're seeing in, say, the manufacturing sector. So it's a pretty heavy lift to get something done legislatively, and then certainly to have the protest be maintained in order to actually effectuate those pauses or stoppages.
Henrietta Treyz of Veda Partners, thank you so much for being with us. There is this disconnect right now, and I think a lot of people have highlighted it. There's a disconnect between how people are feeling and what some of the aggregate numbers are showing. And Neela, I would ask you, how do you reconcile that? The idea that we're not seeing the labor market fall off a cliff, but according to sentiment surveys, some people feel like this is the worst labor market that they've seen in their career.
Anecdotal evidence is powerful, especially on Main Street. And when you have kids coming home from college and they can't get jobs and they're living with you, that is the only anecdotal evidence that you need, that the labor market isn't functioning in the same way that it used to. And just getting back to data centers, enormously important. There's going to be a lot of job creation in building the data center, but the data center is not a factory. Once it's built, it doesn't produce ongoing labor support for local communities, and there is a risk that it increases electricity prices. So that kind of investment is great in the 3 to 5 year term, but is it going to fuel an economy, a local economy, over the next 20 years? That's the kind of job creation that we're looking for.
You can see the pain with something like in Virginia. Glenn Youngkin, a governor who's come on this program a lot, has touted the huge build out that's been going on in that state. I think that's a great point. What happens when the build out is done and it's not continuing to fuel jobs, but just fueling electricity prices? Yeah, with some $500 billion in lease payments that some of these companies have promised to pay. We'll be talking about the labor market. We'll be talking about central bank policy and how government lawmakers respond to this. Coming up, Yahira Anand with your Morning Movers. Micron jumping on an upbeat forecast as we count ahead to a number of rate decisions. This is Bloomberg Surveillance.
Seeing a lift of futures, trying this again one more time, up about 0.5% on S&P futures earlier this morning, keeping those gains. A bigger gain on the NASDAQ after a significant underperformance so far in December, now up 0.8%, largely on Micron, really doing the heavy lifting. Russell 2000 lagging behind with some real questions around the labor market, up 0.3%. If you take a look at the bond space, 2s, 10s, and 30s, a bid into bonds after a kind of motley session led by the front end of the yield curve. The front of the yield curve is pressing down some of the lows that we've seen this year, 3.46%, down 2 basis points on renewed expectations the Fed will cut rates. Is this because of the jawboning of the president? Do you think so? Do you think that he says, well, I want the next Fed chair, it's going to lower rates? Does that actually matter in any way?
Not right now.
But it could coming up. Meanwhile, what you'd see in the 30-year space is just now a basis point decline, 4.82%. Honestly, this is going to be a really interesting end of the week, given that we have not gotten inflation data coming out since September. We also get initial jobless claims 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Micron is the golden child this morning, and a market still nervous around AI. Shares are popping nearly 12% in the pre-market after the company blew past estimates, saying that demand is far outstripping supply, giving them major pricing power. And analysts say that memory chip price increases are unlikely to abate in the near term. Meanwhile, taking a look at Lululemon, shares also popping 6.8% in the pre-market on hopes that Elliott management can help spark a turnaround. That's because it built a stake of more than $1 billion in the struggling retailer. And we're reporting that it is set to be working with Jane Nielsen, a former executive over at Ralph Lauren, to try and spark this turnaround. And she is viewed as a potential CEO candidate. And we end on Instacart. Those shares are falling 6.6% in the pre-market on a Reuters report that the FTC is investigating its AI pricing tool. The agency is looking at claims that customers may be paying more on the app than in stores, something that Instacart disputes, saying that retailers are the ones that set the prices. But it's no surprise that the FTC is going after these claims, especially after President Trump's speech last night on affordability. Lisa.
Thank you so much, Yahira. On our radar this morning, President Donald Trump pledging $17.76 warrior dividend, that is $1,776 of a dividend for troops this Christmas, alongside new plans for housing reforms. This coming as the president faces mounting pressure about his economic agenda. Some questions remain, Danny, about the feasibility of this, as well as the pay-fors that really come into place.
Right, Henrietta Trey saying earlier, find me the votes for this, and then I'll have a thought on it. But the pay-fors, he continues to promise different legislation, different payouts from this government via tariff revenue. If he is able to get the votes, what does this bond market do? What does this bond market do that's been counting on the deficit getting eaten away from the tariff revenue coming in at a time when the Fed's also cutting and at a time where there is stimulus coming in? It is dual stimulus. How does that occur, and how does the bond market react to it?
And if we take that thought and we translate it all the way to Main Street, which is where I spend a lot of time, these issues on housing and affordability are not new, but they're amplified in a situation, in an environment where we have higher than normal and higher than desired inflation. So that's why we keep circling back to housing, because it's housing on top of eggs, on top of everything else that we're spending our money on. And this structural difference in housing over the last 10 years has been the deal maker in terms of wealth creation for the middle class. So the question is, find me the votes. Find me the housing stock, and you'll get the votes.
Yeah, which raises a question about how quickly you can actually turn that around, given the backdrop and given some of the structural undersupply. When it comes to some of these payments, though, how much is that going to be sustainable inflation? I mean, this is sort of one of the key questions. We're talking about other types of dividend payments, the $2,000 dividend checks that people also are going to be getting. I mean, is this inflationary akin to the Biden checks that a lot of people are saying is partly responsible for the real elevation in inflation post-pandemic?
Well, I'm a little bit jaded, because I believe an announcement is not necessarily a policy until it's executed. I learned that the hard way. But we'll see. We'll see the effect of how it lands. You know, there were parts of that stimulus package that actually helped working families quite a bit. The child care tax credit, for example, was a big boom to working families. So how it gets distributed is important. I'm not going to dismiss it out of hand, but there is a risk that it does lead to a bunch of spending and not saving, which could be inflationary, something to keep a close eye on.
In the meantime, one stock is getting a little bit of inflation, I guess in a good way. Micron shares jumping after topping first quarter expectations and posting better than expected revenue guidance. The company sees second quarter earnings to be nearly 80% higher than consensus estimates. Let's just repeat that. Nearly 80% higher than consensus estimates, fueled by relentless AI demand for its data center memory chips. Those shares up almost 12% after rising more than 160% so far this year. I mean, it just highlights how, yes, there are doubts about artificial intelligence, but there's such a robust demand picture that there still are pretty big gains to be had.
There's so much demand, which means that the picks and shovels keep doing really well. But for those that are using it, there's still questions to just how much revenue can come through. So it's this narrative of you need to pick your winners. It is not, if it is a bubble, it's not everything moving in concert higher together. And that's why narratives have become so powerful for this time around, for what's happening in tech. Maybe the previous one, you could kind of say, okay, websites are cool. Anyone can build one. We kind of get that. For this, it's this complicated mess of who benefits? What type of chip is doing well? What is the cash burn? How does this technology actually work? The complicated nature of it means that you get this narrative whiplash, which is such a fascinating setup into 2026 with so many hopes and dreams pinned on AI revolutions.
Yeah, hopes, dreams, and fears. And I think that right now the fears have really taken center stage when it comes to whether valuations are too high, whether we're paying too much, and how much is this going to steal from the labor market. And this is one thing that people keep talking about. How much is the Fed keeping rates lower than they otherwise would out of fear that there is going to be a structural imbalance that's going to leave a lot of people out of work? I mean, are we seeing that in the evidence that that's actually coming to fruition?
You know, there's some evidence at the margin that there is going to be a transition in the workforce. But I don't think AI is a field of dreams. I actually think it's a dream deferred. And that means that you have to create that AI infrastructure first before you see the outcomes and the productivity and the opportunity. And we are in a transition period. So the question is, in my mind, will the equity markets be patient to allow for that ecosystem to be built? And will the employers be patient to allow employees to adapt to the skills that they need for the future? This is a game of wait and see and wait and build. And I'm not sure that we have the patience for that right now.
Certainly the financing markets have had some wobbles when it comes to patience. And that, I think, is a big reason for why we have seen recent skepticism. This is only amplified by cases of fraud. U.S. prosecutors charging the Tricolor Holdings founder, Daniel Chu, with defrauding investors through a massive loan collateral scheme. Chu faces multiple felony counts and at least 10 years of prison convicted. And I have to say, read the details of this story with Excel spreadsheets and a junior investment analyst saying, wait a second, this doesn't add up, leading to the unraveling of this entire scheme.
I hope that junior analyst is no longer junior, that he got a nice promotion and a pay raise, because look at what he wrote on markets. It is incredible. And I think so many people want to say, look, this is just idiosyncratic. It was a fraud. It can't be extended. But the fact that you had so many eyes and so many well-respected borrowers in this company and no one caught it except a junior analyst, I think says something. I was speaking to Victor Koslev, SVP, earlier last week, who basically said, we're looking at 15 companies right now that are facing the kind of issues in their over-leveraged in debt that Tricolor was facing. They're not fraud. It's just an over-leveraged balance sheet and the lack of people to really appreciate the issue that presents until it's too late. That doesn't sound idiosyncratic to me. It sounds like late cycle dynamics.
A lot of people are concerned that that is the case. In the meantime, people also focused on the geopolitics of the moment. EU leaders are set to meet today, facing a key decision on using frozen Russian assets to fund Ukraine's defense efforts in the war. Bloomberg's Oliver Cook joins us now from Brussels. Ollie, thank you so much for being with us. We have seen a pop in optimism that there would be some resolution to this conflict before, let's say, March. That has waned over the past couple of hours. What is going on over there in Brussels?
Yeah, that's the big question, Lisa. And I think that going into this meeting, this makes it a very sort of exciting leaders meeting here in Brussels. And I'd say probably one of the most consequential in the last several years, because before the leaders, and I have to say, going into this meeting, I spoke to the High Representative Kais Kallas, the highest diplomat here at the European Union. I just listened to a number of European leaders walking in and speaking to reporters, basically all weighing in on how they feel about seizing these Russian assets and potentially monetizing them. We do not have consensus going into this meeting. We really do not know when this meeting will will end. We do not know if they will come to a resolution on the frozen Russian assets. We only know that the council president, Antonio Costa, says that he's going to basically lock the doors and say that these leaders cannot leave the room until they figure out a way to finance Ukraine going forward. What they're trying to do is get over the line a 90 billion euro loan that accounts for 2/3 of the funding for Ukraine militarily and the rest of their budget for the next 2 years in order to keep them on their feet in this battle against the Russians. All the while, that is trade negotiations, those peace negotiations going on with the United States in the background. But we do not have a consensus. The German Chancellor Friedrich Merz says there's basically no plan B. The only other option for funding Ukraine, other than seizing these Russian assets, is joint debt. And that probably is the only thing in Europe that is more contentious than actually seizing these Russian assets and monetizing them.
There's also this question of how much they're going to crack down on some of the sanctions on Russian assets, given the fact that energy prices very much in the focus as we do get deeper into winter. How much is there a message for European allies? This is something that a lot of strategists are talking about from what the United States is doing with Venezuela and actually putting some sort of blockade around sanctioned oil tankers.
Well, I think it's very interesting that how far the United States is going on this. We should say that we've had reporting over the last couple of days that the United States is actually considering further sanctions on Russian oil vessels, oil tankers, as well as Russian energy traders. So it's a lever that the Americans are looking to pull potentially. Of course, that they're not going quite as far as Lindsey Graham would like them to go. And we have that bipartisan support for that bill in the United States that would impose secondary sanctions on everybody that's buying crude oil and natural gas from the Russians. Donald Trump has not yet shown the appetite from that, but it does show a little bit that the United States is willing to put a little bit of pressure there on the Russians. For the Europeans, really their last chip to play is on these Russian assets. They've really kind of maxed out their sanction packages so far. So really, of course, energy prices are going to be sort of front and center. But the real question is, are the Americans going to ramp up pressure on the Russians? So far, they've not had the appetite to do it beyond the sanctions they put on Lukoil and Rosneft, which just kicked in a couple of weeks ago, which we should say are fairly significant.
Ali Crook, thank you so much for that reporting and great interview earlier this morning. A real question here about how much energy prices are really underpinning so much of geopolitics, right? Have lower energy prices emboldened on some level this president and other places to potentially crack down a little bit more on some of these increasing issues?
It's such an important undertone to it all because it's the contrast of what was happening in the Biden administration. When the Biden administration lightened up on some of the sanctions on Venezuela and took a more pragmatic approach, saying you can get some more of your oils, of a barrel of oils on the market if you do certain things. What was the difference that time? It was Ukraine and Russia. It was oil prices moving higher, an administration that felt like they had to do something to keep oil prices lower.
And oil prices are important for the trajectory of inflation, right? And so all of these global events, even though they're complicated and they feel a world away, they hit home eventually. And they are the deal maker in terms of the U.S. economy going into the next year.
Yeah, we heard about that $1.99 a gallon, and that was one thing that was driving prices lower. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The U.S. government's acknowledging liability for the deadly mid-air collision between an Army helicopter and an American Airlines jetliner. Court documents state that the FAA violated procedures and that the Army helicopter pilots failed to maintain vigilance. 67 people were killed in the crash on January 29th. Meanwhile, Nick Reiner made his first court appearance yesterday in Los Angeles. He faces 2 counts of first-degree murder in the killing of his parents, actor-director Rob Reiner and his wife, Michelle Singer Reiner. Nick Reiner did not enter a plea. His arraignment was postponed until January 7th at his attorney's request. He is being held without bail. And authorities allege a more than $1 billion fraud by Tricolor founder Daniel Chu was exposed due to an Excel spreadsheet error. One of Chu's top lieutenants failed to reduce the numbers in a column listing the loan's outstanding balances, leaving a glaring mismatch. The discrepancy was flagged by a junior analyst and set off the company's spiral into bankruptcy. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. More on that story later. It really is just amazing. Read all the details. I mean, honestly, the idea that that kind of Excel spreadsheet issue could leave big banks with million-dollar losses highlights just what potentially could be at stake.
And it also highlights that we can't kill Excel for all of the AI glory that's promised out there. Excel
That's your takeaway?
That's my takeaway.
Okay.
We can't get rid of it.
And we can't kill grunt work. Some things you just have to go line by line through every single row in order to find the hidden treasure there.
Exactly. Grunt work and Excel spreadsheets. Up next, all eyes on CPI.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle.
More on the state of the economy with Neela Richardson coming up next. You're watching Bloomberg Surveillance. Trying to turn the page on 2025 in a positive way. It hasn't worked so far in December. Right now, trying to turn that around, up about 0.5% on S&P futures, up even more on the NASDAQ as a result of what we saw from Micron. Better than expected. Absolutely enormous forward-looking growth. We are seeing yields dip just a bit, about 3 basis points decline for 10 years. 10-year yields 4.13%, ahead of the first inflation reading, the first CPI report since September. We will not be getting a comp with October. Nonetheless, it will be some sort of look into what we might be getting come just later this year from the Federal Reserve into next year. When you take a look at these shares in pre-market trading, here is where the lift is coming from, and it has to do with one activist investor. BP shares a little bit lower, down about 0.7% on an executive management change, concerns about some sort of crossover there. But Lululemon shares up 6.7%. Both of these very much in the news due to Elliott Management and their activist stake in trying to enact change. It's just as fascinating to see how this is all coming to roost at the end of the year.
It is. I mean, two completely different businesses, but the common theme is a strategic direction change that Elliott feels needs to happen with a new CEO at the helm. For BP, it's about completely getting rid of renewables and focusing in on a new CEO who, by the way, is the first outsider CEO ever for BP, who comes from a very fossil fuel heavy industry. For Lululemon, it's just the fact that this brand has really been struggling with competition, and it's a consumer that we've been speaking about that's more choosy. So it's not enough just to have apparently a C-suite that's committed to a strategic change. Elliott is saying you need someone at the top, and we have the ability to make that happen.
Yeah, go from spandex to something looser. Compete with Vori. I mean, that's essentially what people are saying with Lulu. They're not actually saying that. Meanwhile, we're looking forward to the economic data we get later this morning. Under surveillance this morning, all eyes on CPI.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle. What do we do with that? Well, it depends how the Federal Reserve responds to it, and how do consumers respond to it? Well, it depends where that inflation is. The composition of inflation, I think, is going to become even more important on a go forward.
Here's the latest. Traders counting down to November CPI data due in less than 2 hours for the first read on inflation since September, as the Fed weighs both sides of its dual mandate. Neela Richardson of ADP still with us. The expectation is for a 3.1% increase in the headline year over year, a 3% increase in core, still above that 2% level. How clean is this read, given some of the government shutdown and collection issues?
It's not as clean as we'd like. Skipping over October is a major miss. We could do that in the labor market. People kind of skip past that 100,000 plus loss in jobs market because they knew there was a driver. It was government layoffs. We can't easily skip past, even though we're going to be forced to, the October data to see that momentum going into the end of the year. That's such an important piece of information. And, you know, we also know that there are gaps in the CPI data in terms of a few cities that will be missing or metro areas. And so putting it together and having that view is really important. I just wish it was as complete a mosaic as we're used to seeing.
I'm getting ready for the conspiracy theories that are going to inevitably emerge after this report, whether it's too high or too low. I got a number of messages yesterday about owner's equivalent rent and how this is the third of the CPI print, and we don't have a sense of how they're calculating it. I mean, how much will hinge on specific idiosyncratic, if you will, Excel spreadsheets that people are going through and determining exactly how this is measured?
I guess this is the day of Excel. I mean, because the drivers are important. Whether inflation, if we see it or if we don't see it, is it coming from the housing market? Because that's a very different set of factors and drivers than if it's coming from energy prices or the goods sector. We thought the inflation in the goods sector was over. If it starts to rise again, if it blows past services into goods, that's a whole different conversation for the Fed, for policymakers. So those those drivers, that momentum, really critical to understanding the complete story.
We'll also go back to some of what we've heard from companies of General Mills saying that they're cutting prices. When it comes to home builders, Leonard saying that they're also having to cut prices and offer incentives in order to get people to actually build homes and buy homes. How much are corporates playing into inflation and maybe lessening inflation right now?
You know, the traffic in the home builder space is really interesting to watch because there is all this tailwind of demographic demand, but is the house at the right price? And right now, there is a sense that companies are absorbing some of those price increases, not passing it on to the consumer because things are still uncertain. Tariff policy is still being set. We don't have a strong read on the consumer right now. And so let's absorb it until we know that we don't have this fickle consumer who will go away from us because we increase the price. So I see that in 2025. I'm not sure companies can continue to do that in 2026. And even though they're absorbing higher prices, they are making changes, and we're seeing that in the labor market. They are not hiring at the same volume at this time of the year as we're used to seeing.
Can I ask, because a lot of these companies are saying it's because of AI. We're rethinking our workforce. We're using more technology. We're being more productive. Sorry, we're announcing these layoffs right before Christmas, but AI made us do that. Neil, how much of that is just an excuse at this point?
I think it is a factor, but I think that these layoffs, these transitions would be happening anyway in many sectors. And if you look at where the sectors are of growth, it's in healthcare. Yes, many healthcare jobs are not AI exposed. That is the case. But there are other sectors like other services like dog walking services and dry cleaning services and leisure and hospitality and restaurants that are still lackluster. So it's not a complete AI is a replacement right now. In fact, there's a sense that AI may augment certain sectors, and you're seeing that as well. So it's just a factor. I wouldn't call it an excuse. Maybe it's a factor, but it's not the whole reason.
Neela Richardson of ADP, thank you so much for being with us this morning. Always wonderful to get your thoughts, especially on a day that is so important economically.
Thanks for having me.
So meanwhile, we are getting a number of rate decisions coming up. We also are going to be getting some earnings. We're getting Nike after the bell. We did just get CarMax earnings. And what I find interesting here is that they did beat expectations, but their comp stores used unit sales actually declined more than expected. And you did see a decline overall year over year. I'm just wondering, are we setting our expectations low, and are we still seeing misses on the margins that indicate really a pushback to higher prices and, frankly, to some of these concerns that we see in the labor market?
Maybe it's finally some of these negative sentiment surveys actually showing up, because that's been so much of the picture. You were talking about this idea that the sentiment surveys have been really poor, but people are still spending. It feels like, yes, they're still spending, but what they're spending on has changed. Things like CarMax, like vehicles, the big expensive ticket items, there seems to be some serious pushback. So maybe finally, maybe not on the headline level, but in the individual level, some of that anxiety is coming true.
Yeah, the nuance, the details is what we're going to be parsing it through as we get the data to try to understand the drivers and just where the sentiment is coming into play. Coming up next, a Bank of England rate decision. Bloomberg's Lizzie Burden breaks it down. Plus, Thomas Kennedy of JP Morgan Asset Management joins us, Erica Najarian of UBS, and Adrian Yee of Barclays as we await those earnings from Nike after the bell. And of course, the marquee event will be CPI as well as jobless claims for the past week. What we get will determine the move maybe into next year. NASDAQ futures higher, 0.8% gain on the heels of Micron, injecting some optimism into what has otherwise been a pessimistic month so far for the AI trade. From New York City, this is Bloomberg Surveillance.
The data we're most focused on, as always, is the earnings.
The earnings backdrop for the S&P 500 looks incredibly strong.
I do think, though, that there are real questions about the cost of doing AI.
This huge run in margin expansion could come to an end.
The reality is, in 2026, AI needs to continue its march forward. We need the fundamental strength that does exist to remain there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, trying to inject optimism into an otherwise pessimistic December for stocks, with futures higher now after 4 days of losses. The Bank of England rate decision coming out right now. They did cut rates to the lowest going back to 2023. ECB up next. Then it's on to U.S. economic data with the first CPI report since September. Danny Berger alongside me. And right now what we are seeing is rate cutting continuing, maybe not here in the United States for the very second, but over in England, they got the green light.
And unlike the rate cuts here, 0 people voted to increase the rate, 5-4 to lower the bank rate. So you did have that divide there. But what happens if it's an ECB that pauses and you get more of a pushback? And Isabel Schnabel talking about hiking rates next year. The BOJ maybe also tightening policy. What happens to the UK and US as they try to do the opposite if bond yields globally move higher off the back of that?
And we did see a 5-4 vote. So if the division in the United States was shocking, well, it's just as divided elsewhere. I'm so pleased to say that Tom Kennedy, the head of real estate investment strategy at JP Morgan Asset Management, is joining us for the hour. Tom, really, I wonder how much this puts some cold water on this idea that the rate cutting cycle globally is over. Is it really, or are people still going to be running their economies hot in a very competitive world?
When the central bank of the United States is still on the verge of cutting rates rather than a holder cutting, it's hard to say we're at the end of the cutting cycle, right? This is the global reserve currency, but we are seeing differentiation across economies, which is something we're really not used to, guys. We haven't seen this for the last decade or so, very synchronized movements. But I think when you look across the world and take the big picture step, is yield curves are normalizing. We are 5 years afterwards really normalizing out of this COVID economy. At least that's what I think interest rates are telling us.
Yeah, I'm not sure if the English economy is normalizing or if this is what they want to be seeing, this sort of dual mandate becoming very much tension. Tom Kennedy of JP Morgan Asset Management is going to be sticking with us for the hour. We do want to get more details from that Bank of England rate decision. Let's head over now to Bloomberg's Lizzie Burden in London. Lizzie, a split decision, although the consensus was to cut rates as widely as expected.
Yeah, it looks like that weaker than expected UK CPI print that we got yesterday didn't actually make this more dovish a cut as perhaps was expected. I was speaking to Banu Bueja of UBS this morning. He had thought that maybe it would be a 9-0 vote split for a cut. It is exactly what was expected before the CPI print. 5-4. You've got the governor as the deciding vote, Andrew Bailey going for a cut this time rather than a hold. And you're seeing the market reacting to this. So you've got yields higher on the 2-year gilt yield at 373, up 3 basis points, the 10-year up a basis point at 448. And so reacting to perhaps the fact that they haven't been more dovish in their reaction to that inflation reading. Now, in terms of the guidance, there was no expected change here. They still say that the path ahead is going to be one of gradual easing. They haven't dropped that. It would have been quite confusing, actually, if they had, given that they don't have a press conference today. And in terms of the pound reaction, you're looking at it really pretty much flat as a pancake, $1.33 at the moment. It had been down against the dollar before this. So actually, if you want to call it anything, perhaps this is a hawkish cut, Lisa.
And Lizzie, it does speak to the challenge of the dual mandate that's happening globally at the moment. How does this set us up for an ECB decision in just over an hour's time?
Well, the ECB is expected actually to sit on its hands, do nothing at all. But it's a difficult message for Christine Lagarde to be communicating, because there we do actually have updated forecasts and they're expected to show inflation, Danny, undershooting the target over the next few years. She's got to balance messaging on that with, if she wants to, pushing back against Isabel Schnabel. We know that she has come out with this hawkish commentary in the past week about how the next move from the ECB is going to be a hike. The market strongly reacting to that. Jens Eichenschmidt at Morgan Stanley saying the repricing is the equivalent to a 25 basis point hike. So if Lagarde doesn't rebut the Schnabel argument, that's going to be saying something. The euro very vulnerable today.
Lizzie Burden, thank you so much for being with us. Tom, I'd love your thoughts on this idea that right now central banks globally are being forced to grapple with the overhang of fiscal deficits that are pretty significant at the same time that they're dealing with sluggish growth. I mean, how much does this create a more compromised independence backdrop for all of these central banks, given these sort of dual mandates coming into play?
I do think it creates a challenge mostly for the market. For the central banks, they need to show transparency about how they weight these two sides of their mandates. And the Federal Reserve, I think, has been doing a good job of hey, we understand you're worried about inflation, but the labor market is really what drives inflation in the long run in this country. And as wages cool, we should expect core inflation to come down. I think it's just really about transparency, Lisa, and giving us a full, honest picture of how they're weighting these risks. It's not an easzy challenge for them.
Which is why you're seeing such conflicted responses and the idea of a 5-4 kind of vote here. Pooja Krumra, European and UK rates senior strategist with TD Securities, joining us now for more. Pooja, what's your take on this, given the fact they did cut rates as widely expected, but what you did see was that fissure increasingly on the committee?
Yeah, no, exactly. It's surprising that the committee is still very divided, as seen from the vote, as well as when it comes to the guidance. They have not given a clear path with respect to the pace of cuts, or we know that BOE is in the upper end of the neutral, which is basically 2 to 3.75. But the guidance around how much below they want to go towards the neutral is really lacking. And I think that has come as a disappointment to markets after yesterday's weak CPI print. And that's why you are seeing gilts actually selling off. Even on the budget side, they consider it to add a point or two on growth. On inflation, they are still seeing medium-term inflation to increase by 0.1 to 0.2. So I think that overall, the messaging is very mixed. Even if you look at Andrew Bailey's comments here, they are looking at the downward trend on labor market, but they still don't want to overread into it. And same with inflation. They don't want to overreact into the numbers that we've seen last time. So overall, I would just say that the mixed messaging is something that's not changed. Markets were still worried about the pace of easing by the BOE. You know, markets were pricing around the next cut around April. And the current messaging does not really change that situation. There's just no pace or what type of momentum in terms of cuts we'll see from BOE. And it's not been consistent as in the case of Fed or in terms of ECB. But I think it's the data that will be speaking. And if we do see that inflation and labor market easing, the next cut should be by Q1 in our view.
And just to the point of the division, Pooja, and the not clear outlook, part of the statement was that judgments on further easing will become a closer call. How much room is there to cut at this moment if the data stays similar to how it is now, Pooja?
So markets-wise, again, there is not much room within. They're just looking for another cut from the BOE. And the timing was around May, and I don't think that changes right now. To us, again, like we also think that BOE definitely has room for one more cut. They will be still in the restrictive stance. If you see the neutral range for them is, as I said, is around 2 to 3.75. So they're actually in the upper end of the neutral. So there is a lot of room to ease, but the evidence in terms of labor market and inflation has been very slow moving in UK, and that's why they want to keep the easing path slower than what should be the case. So we and markets are particularly looking for just one more cut, but I think the risks are for more cuts when it comes to UK.
Pooja Krumra of TD Securities, thank you so much for being with us. Tom Kennedy alongside us this morning. And I am wondering, just zooming back as we await the ECB rate decision and after this rate cut, do we have a sense of just how much more inflationary the current moment is than pre-pandemic? Do we have a sense of what room there is for central banks globally to truly engage in a cutting cycle?
In most of the developed world, I think you have to look to the wage market to tell you what underlying inflation trends look like. In wages in America, we just got ECI prints, which is the gold standard for the central bank in the U.S. You're still seeing wage growth about a half a percentage point growth higher than what it was pre-COVID. So that would tell you that there is still more inflationary pressure in the economy. But to some degree, that is backward looking. You need to look at more data points. And when you look at the labor market, we finally got the jobs report, and it looked okay. But on the skew, similar to what Pooja's saying, I think you're skewing towards a little bit weaker than what the headline numbers look like. And there I'm looking to breadth of job growth in America. Year to date, most of the job growth is just healthcare. I'm looking to what's happening for young kids coming out of college. The unemployment rate for them is the highest it's ever been relative to the overall unemployment rate. And then just turnover in the JOLTS market. There's not a lot of turnover. So I think if you're a central bank, you say, things look okay, but if we have to do anything, we need to cut. And in the developed world, that's for the most part what's happening, kind of ex-Japan.
But if you're going to be forward-looking, don't you also have to take into account that we're getting cuts and fiscal stimulus at the same time. Not even from the U.S. You mentioned it in the last hour, the fact that Germany is going on a record debt spending binge. Doesn't all of that mean we could also potentially be cutting into an upturn and dual inflation when inflation is still not at target?
Yeah, Pooja hit it exactly right. Where is the neutral rate? Where are we across the developed world? I think most of the central banks say they're still above neutral. So they can cut a little bit and see what happens. And this is the exact reason why, Danny. You look out to 26, the big, beautiful bill is going to hit. Best estimates from economists is that's going to add about 1 percentage point to GDP growth. Wow, that's a lot of muscle coming in. And then you can look at, really, as sentiment is turning, what are your forward indicators that you can trust? CEO confidence, small business hiring intentions. So I do think you have to cut, kind of see what happens. I think the BOE and the Fed are kind of in the same exact spot with that. But look, if you're going to really count on the labor market, it's telling you if you're doing anything, you're cutting. I think that's a really important thing for the market, is that the probability of hikes is very, very low in 26. So that can give us confidence to add duration, add diversification portfolios.
Which is what you have been seeing a lot of people saying, although a little pushback recently on the long end of the yield curve. We'll get into that in just a second. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Trump administration announcing a massive arms deal with Taiwan. It's valued up to $11 billion and includes missiles, drones, and more. China's foreign ministry attacked the move, saying it would violate diplomatic agreements between China and the U.S. and undermine regional stability. Meanwhile, Medline shares soared more than 40% in their market debut yesterday, though they are pulling back this morning. The company raised over $6 billion in this year's biggest IPO. Medline, which manufactures and distributes medical supplies, has a market value of about $55 billion based on the trading. And moderate House Republicans have joined with Democrats to force a vote in January on expiring Obamacare subsidies. The rebellion comes after Speaker Mike Johnson blocked a floor vote on a plan to extend the subsidies with cost-saving changes. The vote will be forced after a discharge petition reached 218 votes, which is a majority of the House. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, bringing the economy back.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history.
Merry Christmas. Bloomberg's Tyler Kindle joins us next from New York. This is Bloomberg Surveillance. Seeing a lift to two markets ahead of the open after a soggy December. We have seen losses for 4 straight trading sessions today, trying to snap it on the heels of Micron. Some optimism coming from that. Futures up about 0.5%. Seeing a bit of euro weakness ahead of the ECB rate decision. We did see, of course, from the Bank of England, a rate cut on the expectations of slowing inflation. And in the United States, ahead of the CPI print, we do have 2 basis points of a decline on the 10-year, with 4.14% in focus. Under surveillance this morning, bringing the economy back.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Here's the latest. President Trump touting his economic record as he looks to reassure Americans' pocketbook concerns. This as polls showing his approval rating slipping near the lowest level of his second term. Bloomberg's Tyler Kendall joining us now. Tyler, this is rare for President Trump. He rarely has given primetime addresses. Last night, there were pretty high expectations. What were the underlying announcements that really came to the fore?
Yeah, Haley. So, well, it's clear that the White House has been trying to hone its messaging when it comes to the economy and affordability, which is part of why President Trump utilized this speech in prime time. As you're saying, not typically expected from him, since we know that he prefers really the larger crowds like we saw the other week in Pennsylvania. Now, President Trump put a few ideas out there, some new, some repeated, some that would require congressional approval. And that's a really important theme to keep in mind here because, of course, every seat in the House of Representatives is up for election next year in the midterms, which could change the political calculus of what ultimately ends up getting passed and turned into law. Now, the newest policy that the president floated was what you heard him refer to as these warrior dividend checks that are going to U.S. service members, and he says will be funded through tariff revenue. Now, he says the checks are already in the mail. At the moment, it is not totally clear the legal authority that's been invoked, though there is reporting this money was already allocated and appropriated under the One Big Beautiful Bill. But of course, it is reminiscent of another idea that he put out there again, which is that we could see tariff refund revenue checks more broadly for Americans. But we do know that that would likely require congressional approval and a whole new separate form of legislation. And I have to say, if you go to Capitol Hill and talk to Republicans about this, many of them would prefer to see that money go towards paying down our national debt. The other bucket of proposals to look out for in the new year, I would say, was focused on President Trump saying that we could see aggressive reforms when it comes to housing. He was light on specifics, though we do know that he campaigned, of course, heavily on the idea of deregulation in the industry. Lisa, I have to say that in the last few weeks, of course, affordability has really been front and center in the conversation here in Washington, and that has to do with health care. We were expecting President Trump to touch on the issue, though, again, light on specifics. He did outline his opposition to those expiring Affordable Care Act premium tax subsidies, saying that he would rather see money go towards consumers instead of as subsidies to insurance companies, but he didn't put his support behind any of the legislation that's currently brewing on Capitol Hill.
Tyler Kendall, thank you so much for being with us. Tom Kennedy of JP Morgan Asset Management still with us. And Tom, the descriptions of the U.S. economy are all over the place. People's sentiment certainly all over the place. Economists' interpretation of the data all over the place. What's your take on why now, ahead of CPI and ahead of a holiday season, did we get this kind of address given some of the backdrop of polls that we see for this president?
It's as if you're around our desk yesterday trying to figure out why the announcement, why now. I think we looked at the polling numbers, too. Also think, to your point, we're getting an inflation data print for the first time in a couple months. It's a curious timing. We don't really know. When we look to CPI, we do feel that customers in America and our Chase customers are feeling some pain. JP Morgan has the best data in the world on the consumer. And we bank over 50% of American households. We have at least one product there. It gives us great insight. What we see right now is a very divided consumer in America, that K-shaped economy that we talk about a lot. Top 10% of income earners, which account for about 50% of all consumption in America, are doing just fine. Their spending growth is above the rate of inflation. And in this holiday season so far, we've seen them spend on big ticket items. The bottom 90% of income earners, though, their spending growth is below the rate of inflation. So their real spending is negative. I think that might be some of this economic pain that people talk about a lot. That's a really tough challenge for monetary policy, for fiscal policy, but that could be the reason why he was talking last night.
Well, if you do have a world, which we are in now, where there's basically 0% jobs growth, 3.5% wage growth, and a 3% inflation, that doesn't leave a lot of room for household spending. But to your point, the K-shape means that the spending has occurred. At what point does that stop? And the K-shape is no longer enough to sustain the economy on a headline level.
Yeah, Danny, this is what's driving this K-shaped economy. Income inequality goes on for a long time. That stat, 50% of all consumption happens with the top 10% of income earners. 30 years ago, they accounted for just 35% of all consumption. So income inequality is happening. But I think what also supports this K-shaped economy is that financial conditions, real estate prices going higher, stocks going higher, those are mostly owned by the top 10% of Americans. So what makes it stop? Well, we could see Main Street focus and consumption at the bottom pick up. Or if we saw a crack in financial conditions, maybe we would see the top side come down. This is also what makes our jobs very hard. There are two different experiences that are happening. You come back to a central bank. What are they focused on? The bottom side of the K. And you come back to, I think, last night, the president, he's very much focused on the bottom side of the K. So hopefully that's what we get. The bottom side comes up. So I think there's reason to think that will happen in 2026 too, though.
You were just kind of hinting there also what that's done to markets. And it's actually something that I was speaking with Ken Griffin earlier this week, too. Yeah. A world in which bond yields are moving higher because of that pressure, inflation's still sticky, and yet equity markets that love the idea that this economy is going to be run hot. There was a survey done by the other side of the house at JP Morgan basically saying that people were ditching constructed portfolios like 60-40, that they were just putting together their own equity portfolios, and their hedge was gold, not bonds, because of the split that we're seeing. Yeah. Are you seeing that among your clients too, that there's this real desire that we don't want the hedge from bonds, but man, oh man, equities are hot and maybe we find some diversification elsewhere?
I think you have to start with what most Americans own. They own the S&P 500. Top 10 stocks in the S&P 500, 8 of them are tech companies, if you use tech companies broadly. That's 35% of the index. So you start every conversation with, I know you own the S&P 500, you have a heavy concentration in tech. You could be a tech believer and still say, I need to diversify. Looking backwards, our job was just to add bonds. It was just easy. Inverse correlation was there. And we've been saying it, JP Morgan's been saying it for years now. That inverse correlation is not real anymore. Stocks and bonds positively correlate. We need new diversifiers. Commercial real estate stands out as one that should diversify really well. It's positive income and prices. It's the only asset class where prices haven't come back to where they were pre-COVID. And then you could look at infrastructure, hedge funds, gold. I do think it's funny how much we talk about gold and how small it is in portfolios, but that's, an aside.
I know that you do focus on real estate, and this is a big central part of the president's agenda, and it's also a big question mark because it used to be one of the main stores of wealth for so many different households. That's now obsolete for a lot of incoming household creators who don't have that capacity. How can you get a more healthy market, a healthier market, without prices coming materially lower, right? How can you have a healthier market going forward that doesn't include a good degree of pain that forces some sort of capitulation in the space?
I think you have to start with what is that epicenter of wealth over the years? 2/3 of Americans own their home, and it's the biggest asset they own. Okay, prices go up, they feel good. And it produces a wealth effect as well. But right now, the average first-time home buyer in America is 40 years old. Up from 33 7 years ago. So we're creating this generation of renters that are being pushed into the market where they can't get the American dream the way we thought about it. So that creates an income stream for all Americans to access. The democratization of alts is bringing this new investment idea to them, and we're seeing adoption beyond traditional pensioners and insurance funds. So this becomes a way to diversify in a portfolio that more people have access to. And especially if they can't get the American dream kind of idea, this is one way to fill their portfolio.
American Dream Light. Own a stream of revenue from rent. Yeah, exactly. Rather than actually the home, because ultimately you've got to diversify. But it's a great point. I mean, this to me is really the highlight. People don't have their money tied up in homes, right? So it has to go elsewhere, and that's what you're seeing in this space.
And it leads to the anxiety that people feel because they can't tie their money up in homes, because that was the American dream. But yeah, it speaks to the real boom in alternatives right now. How do you find ways to put that money to work if it's not bond markets that's not giving you that diversification anymore?
Luckily, we've got Tom Kennedy with us the entire hour, which I'm so pleased to say, of JP Morgan Asset Management. Coming up, we're going to speak with Erica Najarian of UBS as Wall Street bets on a mergers and acquisitions boost. We've already seen quite the boost with a whole host of mega deals on deck. What could come next? Yahya Anand is also going to be joining with your morning movers. Trump media jumping as it gets into the business of fusion energy. We'll explain. We'll attempt to explain. Tom Kennedy will explain. Tom, you'll read it on that in the break. From New York, this is Bloomberg Surveillance. Good morning. Seeing a boost to equities after 4 straight days of losses, led for now at least by big tech on the heels of Micron, which you can see is just about an 0.8% gain on NASDAQ futures. S&P up about half that, about 0.4%. Russell 2000 lagging behind as people question just how much heat there is in the U.S. economy in 2s, 10s, and 30s. That's the reason why you're getting a bit of bid into bonds, particularly on the front end as people look to possibly more rate cuts early next year from the Federal Federal Reserve following what we saw from the Bank of England. 3.46% on the 2-year yield. That 30-year yield just pinned there at 4.83%. Take a look at the pound intraday. You did see a pop initially after the decision came out, 5-4, a hawkish cut down to the lowest level going back to 2023. It's now just about flat. But Danny, really highlighting some of the concerns that people have about the Bank of England's ability to cut more, even with a deteriorating economic backdrop.
And the Bank of England highlighted that themselves, the lower propensity of their ability to cut because of what's happening with inflation. It mirrors the conversation happening with a lot of central banks, be it here in the U.S., largely expected to cut, but a division really growing among the board. The ECB, they're expected to hold today at 8:15 a.m. when you had an ECB official just this month saying that maybe the next move is going to be a hike. That's not consensus, but it's a growing divide because of this pressure from the dual mandates.
Nobody on the Bank of England voted to hike rates. So there is that. Right now, 2 hours away from the cash open, here are your morning movers with Yahira, Anna, and Yahira.
Hi, Lisa. Micron to the rescue in this jittery market. We are seeing shares popping now 14.5% in the pre-market after the company blew past estimates, saying that demand for its memory chips is far outstripping supply, and that is giving them major pricing power. What analysts are saying is that those price increases for those memory chips are unlikely to abate anytime soon. So it bodes well for Micron. Meanwhile, moving on to Trump Media, those shares are popping 22% in the pre-market on news in the last hour that the social media company behind Truth Social is getting into the fusion power business by merging with TAE Technologies in a $6 billion all-stock transaction. It is an unusual tie-up, but of course it is tied around this bet on the insatiable power demand needed to run AI data centers. And we end on Medline. The stock is pulling back this morning, down 6% in the pre-market after an explosive market debut yesterday that saw shares pop more than 40%. This is a medical supplies company that does provide everyday gear for hospitals, so it's not a big tech company, and it raised more than $6 billion in the biggest IPO this year, capping off a strong showing for listings here in the U.S. in 2025. Lisa.
Thank you so much, Yahira. Tom Kennedy of JP Morgan here, having done a deep dive into Trump Media and nuclear fusion and the connection between the two. So what'd you come up with?
I'll have to get back to you guys next week. Invite me back.
I'll have you back. Tom Kennedy's hot take on that. Our narrator this morning. President Trump saying he will announce his nominee to replace Federal Reserve Chair Jay Powell soon.
Soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot, and mortgage payments will be coming down even further.
Fed Governor Christopher Waller, NEC Director Kevin Hassett, and former Fed Governor Kevin Warsh are all considered the top contenders to replace Powell. Really, the ultimate question comes down to how much does it really matter? I mean, Tom, does it matter in any way, shape, or form who the next Fed chair is if it is a committee that has to vote on something and be some sort of consensus?
It definitely matters. But it matters a little bit less when you can acknowledge that it's a committee, and it is a committee when you're in the room. That's exactly the way it will work. But we're used to Fed chairs that gather consensus, and they bring the committee along, and they shepherd the market in a very smooth way. Look, one of the biggest adversaries of an investment portfolio is volatility. So if the Fed chair is adding volatility, that's a big problem. When you look at all three of these, I think the market will accept them and it will be fine. I think Waller is the one who's the known quantity, so we'll bring volatility down. And he still has been very vocal about advocating for interest rate cuts in a framework, data-based way.
It speaks to this idea that one of the important tools the Fed has is communication, that they're able to reshape markets by building this consensus and having a Fed chair at the helm who can communicate that. On the other side of things, Jason Furman, now of Harvard, previously worked in the government, saying, hey, this is a good thing. He's not the only person saying that, but this is a good thing to have a diversity of ideas within the Fed. It's a healthy thing not to have a godlike figure who's at the Fed, is the chair, and decides everything for everybody else.
I know that Jay Powell is very happy that you're implying that he's a godlike figure. Meanwhile, BP appointing Meg O'Neill as CEO, replacing Murray Auchincloss. The change coming as the oil giant struggles to revive its fortunes after a botched pivot toward renewables. O'Neill will be the big oil's first female leader. We'll get into that in a bit with Elliot's fingerprints on this as well. Meanwhile, OpenAI is reportedly in talks to raise tens of billions of dollars in evaluation valuation of about $750 billion. According to the tech news website, the information discussions are preliminary and the details could change. It just highlights how OpenAI is at the center of absolutely everything when people talk about their worries about overspend in AI.
Yeah, and maybe the benefit that OpenAI has is that its funding rounds happen in private, in the dark. You don't necessarily see ramifications in public debt markets that you would in an Oracle, for example. And the news that Blue Owl wouldn't be a part of this Michigan data center that they're having, because that is the fear. Maybe we're kind of misplaced worrying about a bubble in valuations. Maybe it's whether just or not that they can continue to get funding for their data center build out. What happens if you have more players and more bond markets starting to rebel against the idea?
Maybe OpenAI will just get purchased by NVIDIA. Maybe this will be one of the M&A deals announced. Actually, no one is speculating about that, but there will be a lot of M&A next year. This is the expectation from Wall Street. Erica Najarian of UBS writing, banks might be more motivated to close larger deals ahead of any potential shift in power in Congress. The first half of 2026 could be a robust time for deal announcements. Erica, I'm so pleased to say, joins us now. Erica, great to see you.
Good to see you.
I'm not saying that OpenAI and NVIDIA are going to merge, but there is this feeling that there is an acceleration in the deal space. Just how much pipeline is there behind that?
I think bankers are not going to have a fun Christmas season. I think they're going to be at their desk working because I think 2026 is going to be the year of big. You know, I cover banks, so whenever we talk about M&A, we think about regional banks merging for synergies. But given the deregulatory framework, and given that you do have the midterms as sort of an important waypoint in time, you know, I think you could have banks and other companies across the space really thinking about where their strategic holes are and addressing it that way. So I think it's going to be more than just, okay, we're going to do deals to cut costs. I think they're going to use this as sort of a, you know, once in a generation opportunity to redeploy capital in a very specific strategic way.
Because a lot of the deals we've seen have been really big. I mean, whether it be in IPOs, the Medline IPO coming on the market earlier this year with EA, the huge amount of numbers that are being put to that. Whatever is going to happen with Warner Brothers Discovery, maybe we add that in, that whole hot mess of a potato in with that too. How much of this and the resurgence of deals are about big size deals versus volume of deals?
I think you could get both, right? So first of all, the sponsors haven't really, exited much, so we're waiting for that. You know, the market is at all-time highs, spreads are at all-time tights. So it feels like now is the time. And I was here last week when I had this analogy that this administration was going to put lipstick and contour on this economy to get it through the finish line for, to the November, midterms, right? And so you could have sort of also a macro backdrop, and maybe we get one or two rate cuts that's quite favorable for this environment.
By the way, can I just say we should only start using makeup metaphors and no more baseball metaphors. No more innings, only lipstick and contour. I'm absolutely on board with that, Erica. How much of this, though, when it comes to strategics versus private capital? Because to your point, they're still sitting on a lot that they need to exit. Are they willing to take a discount, or has the environment gotten so good that things that they maybe overspent on in 2021 and 2022, they can sell at a price that they agree to?
I think you still have a pretty significant valuation disparity. And I think you also have, your deployment of capital is not going to be as, those investments are not necessarily going to be as good as those that you're trying to exit, right? So I think that's going to be, continue to be a challenge. But nevertheless, I think in particular I think the advisory pipeline is going to be, is actually quite strong. And you had the government shutdown. So the fourth quarter is going to look a little bit light. So that's going to have the effect of pushing a lot of these announcements into the first quarter. And so you're, every sort of Sunday evening or Monday morning is going to be boom, boom, boom in terms of announcements, I think, when we kickstart the year.
Talk to me a little bit more about the financial M&A.
Yeah.
On the strategic side, what are the strategic priorities of an M&A for banks at this point if it's going to happen in the first half of next year?
So scale and completeness, in my opinion. And additionally, an edge in tech. So, for example, it's pretty clear that scale is getting to be even more important given the technological demands, the investments that are needed in AI and the like, right? So that's number one. Number two, you work at a company that's very diverse, for example, right? And so the whole idea of a booming money center, complete money center bank, I think is, highly subscribed by the market. So let's say you're an investment bank, maybe you're seeking more of a wealth aspect, or Wells Fargo has mentioned potentially expanding in growth areas if it were appropriate. So these are sort of the strategic points that I think are going to be addressed in the new year.
A lot of people are very excited about financials at the same time that they're very concerned about some sort of glut in private credit, some sort of excess that could potentially come to roost in 2026. Is there a dissonance in this, the idea that people think that there is no credit risk in banks, but there is full credit risk in private credit?
You can't have an explosion without getting shrapnel. Right? So I would say a couple of things. Number one, everybody is hyped about bank stocks, but bank stocks rarely outperform the S&P 2 years in a row. Right? And when it's happened on the back of a recovery cycle, right? Think post GFC or post the dot-com bubble, right? So the bar is high. Second, we have to watch the sector rather than just say, okay, there's something out there that we have to be nervous about. What do I mean? Is there froth in data centers? Is there froth in, other so it's really a sector issue rather than structure. So really it's going to be, right, what the banks have done is they've indirectly lent to financial institutions that then lent to the companies, right? And we saw in the matter of the, First Brands, for example, that when you have, an explosion, obviously there's fraud, the banks will catch some shrapnel. So we'll see.
Well, Tom, to this point, I mean, how much are people understating some of the credit risks here, given the concerns about the likes of Tricolor or First Brands?
I think what Eric is trying to drive out here, too, is the important piece of this. It can't be just private credit's the issue and not the banks. I mean, let's just acknowledge that up front. But as you're moving through this froth, I think the way you made the comment about the fraud is, when we look back in history, guys, fraud is a bankruptcy. It's not it's fraud, that gets an asterisk. Like, if we have these types of problems that are going to surface, I do think the banks will get tied down to that. So maybe, Erica, last question. As you separate these, which banks are best positioned into 2026 if we were to hit a default cycle? Just the well-diversified banks, or is there something to that, or an angle that you focus on?
And by the way, it's not a coincidence that Tricolor and First Brands were in the same sector, right? So this goes back to what I was saying. It has to be a sector. Look, I really like Bank of America here. Right? So all the things that, perhaps was a negative for Bank of America, to directly answer your question, not growing as fast as others, being a little bit more conservative in an environment where, there's a little bit more uncertainty and maybe we are just band-aiding the economy. I think they, could potentially perform well, and the valuation is, not all that demanding. A company like, Capital One, that lower end of the K has taken hits already, right? I mean, we've talked a lot about the K-shaped economy, but who's been dealing with inflation since 2021? It's been the lower end of the K. So I think that, those two stocks set up really well for 26.
Erica, thank you so much, as always, for being with us. Erica Najarian of UBS. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Calls are growing for the EU to approve a massive loan to Ukraine backed by frozen Russian assets without the support of Belgium. Kyiv's finances are likely to run out in a matter of months without the boost. Meanwhile, U.S. and Russian officials are set to meet in Miami this weekend for continuing talks on a peace plan. Meanwhile, a Warner Brothers Discovery shareholder has approached New York hedge fund Standard General to acquire all or part of its cable TV assets. The Financial Times reports the fund's founder, Soo Kim, has been involved in the talks, which would include the sale of CNN. It comes after Warner Brothers urged shareholders to reject a $108 billion hostile takeover offer from Paramount Skydance. And Trump Media and Technology Group agreeing to merge with TAE Technologies in an all-stock transaction valued at more than $6 billion. The transaction is set to create one of the world's first publicly traded fusion companies. The new venture plans to begin construction on a utility-scale power plant as early as next year. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, inflation signals.
We are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Adrienne Yee of Barclays joins us next on The Consumer. This is Bloomberg Surveillance. Seeing a bounce to equities after 4 straight days of losses. It's coming from the tech sector after the tech has lagged behind. Micron giving a bit of optimism here. Meanwhile, yields bid, but not as much as earlier in the session. Now almost 4.14% on the 10-year. Take a look at Nike shares. Pre-market trading up almost 1% ahead of earnings after the bell. Those shares lower about 11% so far this year. Can they deliver on a turnaround strategy? And what do they say about the U.S. consumer in particular? Under surveillance this morning, inflation signals.
There seems to be this view in the Fed that inflation is really not a problem right now. I think it's a little too premature to think that inflation is going to take care of itself. We are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Here's the latest. The November CPI print dropping this morning, set to offer investors a partial snapshot of inflation ahead of the new year. Adrienne Yee of Barclays saying the consumer has shown resilience this year, but sees, quote, potential tariff-driven inflation on the horizon. Adrienne joins us now. Adrienne, thank you so much for being with us. We've seen this when parsing through all of the retail earnings, how different companies have managed through inflation. Do you think this is just the beginning in terms of being able to selectively increase prices on specific goods?
Yeah, actually, we have not actually seen broad-scale inflation across apparel and footwear. I'll talk about kind of year-to-date what we've seen inflation sort of in the hard lines, home furnishing sector. And then the footwear industry was actually ahead of the inflationary price increases. So they broadly, Nike, On, Hoka, they all took price increases up by about mid-single digit in July. Across apparel, we've seen virtually no price increases, but for just modest kind of normal way price increases. And so really what you're seeing with the strength of the economy is pricing that has been relatively benign in terms of inflationary pressure. And yet the cost side of it, the margin side of it, actually still hasn't come through on the P&L either. So all of this is horizon risk for the forward kind of spring season when you'll see, the other 80% of apparel discretionary actually start to raise prices. And that's when we'll see kind of demand destruction.
Adrienne,
yes.
Does Nike, though, have the ability within all of these macro headwinds to also deliver the innovation that should they need to readjust prices or should they not want to keep discounting, they can get consumers to the stores and buying new sneakers?
So this is so what you're describing is turning a product around and a brand around that has lost some of its brand heat and raising prices while doing so. Those two things are incongruous. They are very difficult to happen at the same time. And what I will say is that Nike has cleaned up the marketplace. Remember, there were this big 3 classics, the Air Force One, the AJ Air Jordan One, and the Dunks, which they removed because there was just lack of innovation. So what we're seeing with Nike is strength in their performance run. So the Pegasus, the Vomero, right, the Structure, the Invincible. In that performance run, they're sort of catching up to where On and Hoka had been with that thicker platform. So it remains really to be seen whether they can take that one portion of the performance piece of the business and then bolt on kind of the leisure lifestyle, right? The strength that they typically have seen kind of in the marketplace. Our preview would suggest that they are going to beat the quarter this evening. Usually when you're giving that guidance, you're giving it mid-quarter, you have a very good look at the wholesale order book in the quarter. I think they will talk positively about the forward spring order book. Having said that, they're anniversarying a lot of the reset actions that they did last year. And so they're going to forego some of these low quality sales in the third and the fourth quarter, their fiscal third and fourth quarters. And that may kind of cap the top line. Margins should be better, but the top line probably will be constrained. And I'll say my final point here is not about FY26. FY26 ending May should be fine. We'll beat the second quarter. We'll kind of temper the back half. But it's really about the forward 2 years where we're looking for 400 basis points of margin expansion with 10% top line growth. Those things don't happen at the same time.
Adrian, I wonder when companies are trying to mount this turnaround, especially with all these headwinds, be it, locally with their innovation or the macro headwinds, how important it is at who's at the top. And I ask this because Nike, new CEO just last year in October 2024. This week, the discussions around Lululemon with an exit of their CEO and Elliott pushing for a new one from Ralph Lauren. Adrian, can these changes happen if you have the old guard at the top, or for apparel and consumer-facing companies struggling? Do they need to have a rethink of their C-suite in order to succeed?
Absolutely. It's one of the things that we're learning through all this tumultuous time, right, for the past 5 years, frankly, for the past 10 years. We've had the digital economy. We've had COVID. We've had, a supply chain, right? The supply chain was stuck for 2022. So you've had inventory issues, supply chain issues, everything. And what I would say is the guiding factor for investors and for us as analyzing companies is you are investing in the management, and you are investing in the confidence that they can navigate each one of these successively, even though they don't know what the next shock event's going to be, that they have the wherewithal to do that over time. So absolutely. And the final thing that I'll say here is what you're looking for in that management. In consumer retail, you are looking for product, brand, customer experience. Those are the three things you want to hear the management's talking about. And you hear that from Elliott Hill at Nike. You hear that from the new Gap CEO, Richard Dixon. And it's no surprise that you're starting to see some of those changes happen at those companies.
Adrian Yee of Barclays, thank you so much for being with us. Tom Kennedy, a final word here ahead of CPI and jobless claims. What do you think we're going to be most surprised about heading into 2026? The resilience of the consumer, or the consumer falling off?
I think we'll be surprised about the resiliency of the consumer thanks to the big, beautiful bill and the rate cuts coming through. I think consumer will be resilient. I think the things we need to be looking out for are how persistent can this tariff-led inflation be? The Fed's banking it won't be. It's going to be a one-time shock. So we need to look for that and then really think that the K-shaped economy will close a little bit in a positive way where the bottom end comes up. I think that's the most likely outlook for 26.
Tom Kennedy, it is a pleasure having you here. Thank you so much for spending the hour with us. Let's do it again sometime soon. Tom Kennedy of JP Morgan Asset Management. Danny Berger, I believe you're doing 45 hours of TV today, so we're going to let you go prepare for the rest of it. Always wonderful to see you. And a great interview with Ken Griffin earlier this week. Really interesting. If you haven't seen it, check it out on YouTube or the Bloomberg website. Coming up next hour, as we do await that economic data, Emily Rowland of John Hancock, Seema Shah of Principal Asset Management, Aaron McLaughlin of the Conference Board, and Brent Schutte of Northwestern Mutual. This is Bloomberg Surveillance. Good morning.
There are a lot of tailwinds supporting the economy for next year.
You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem.
One of the key themes that we've noted for this year is people really underpricing kind of the macro risk.
We still have a problem with inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. CPI on deck along with jobless claims in about a half an hour as we try to end the year on a high note. Also waiting for an ECB rate decision following that Bank of England rate cut about an hour ago. All eyes very much on the U.S. consumer as we suss out any sense of the U.S. economy heading into next year. David Gura back in the hot seat, I'm so pleased to say, joining us for the next hour. And David, really it is all going to be about what we get in a half an hour time. The first CPI report from the United States going back to September.
Absolutely, and an incomplete one, so we'll see sort of what actual tangible information we get from that. And of course, that dovetailing with, complemented by this ECB decision, Yes, Christine Lagarde's going to be speaking, but Isabel Schnabel, member of the Governing Council, looming large in light of the comments that she made to Bloomberg earlier this week.
The idea of potentially hiking rates, not cutting them. Nonetheless, as we were talking about with Tom Kennedy in the last hour, he was saying, look, there is a bias to cut rates right now because the labor market front and center is clearly showing signs of weakening, possibly beyond what's being shown by headline numbers. So at a certain point, what's more important, CPI or jobless claims with this kind of backdrop from the United States?
The debate continues. I took a few days off, came back. It seems like we're dealing with the same issues over and over again, the kind of preeminence of the central bank versus what's happening in the AI space. Lo and behold, good news in the AI space yesterday, and we see markets reacting strongly to that this morning.
Yeah, just a cheat sheet. We're going to be talking about the same theme for probably the next 6 months.
Beautiful.
So, David, if you take a break, come back. Hopefully you don't take a break. We love having you. Right now, you are seeing a bit of a snap in that 4-day losing streak as people try to get some optimism, as David was talking about. Maybe Micron helping to boost spirits, 0.4% gain on S&P futures. We are seeing just a bit of euro weakness ahead of that ECB rate decision, 117 on the euro-dollar cross, and 10-year yields lower by more than 2 basis points, 4.13%. Crude still in that $50 to $60 range, although climbing just a bit after yesterday, the potential for some sort of disruption in Venezuela. Coming up this hour, do not miss this. The great Emily Rowland of John Hancock Investment Management as stocks are rising. Seema Shah of Principal Asset Management as Europeans' central bank is set to make its final rate decision of 2026. And Aaron McLaughlin of the Conference Board breaking down the November CPI data. We begin this hour with stocks looking to snap that 4-day losing streak. Emily Rowland of John Hancock Investment Management writing, we are constructive on U.S. equities into 2026. We still see an impressive earnings engine driven from AI productivity gains. The challenge we continue to face is that valuations are rich. And Emily joins us right now. Thank you so much for being with us. Great to see you. I'm curious about valuations. The fact that everyone is so worried about valuations, how much relief does that give you?
Yeah, I mean, look, we're at 22.5 times forward earnings. The highest in history was 24 times. So we're not going to see a lot of multiple expansion into next year. But the good news is that the earnings engine in the United States is on. Analysts are looking at 14% earnings growth for next year. So the denominator is almost more important to us than the numerator here. And there are some tailwinds for U.S. companies into next year. We've got the provisions in the One Big Beautiful Bill, lowering the effective corporate tax rate. We have oil prices falling. That's great for the consumer. It's good for transportation costs for businesses. We've got the U.S. dollar falling. We just saw one of the weakest years for the dollar in modern history. Remember, 40% of the revenues of U.S. companies are derived from overseas. So there's a lot of things happening that I think can go right for companies into next year. It's just, is the bar too high?
Well, is the bar too high for big tech, and can big tech lead? Because all of the companies in the sectors that you just mentioned were consumer facing, were companies that were not necessarily in this haloed sphere of the Magnificent Seven. Yeah. I know you have been overweight big tech for the bulk of 2025. Are you shifting that heading into 2026 because of this type of thesis of strength elsewhere?
Yeah, I mean, we are looking for a broadening out in terms of market participation, and we're already seeing that with sectors like healthcare and industrials getting in the mix. We are always firm believers of following where the earnings are going, and we are expected to see earnings delivered by different sectors in the S&P 500 next year. We still want quality. We want to find it at a reasonable price. We want to look for relative value. And look, we still like tech, but there's no doubt about it. It's expensive. The S&P 500 growth index trading at about a 50% premium to its long-term average. We like the high quality parts of tech, but there's been a bit of a dash for trash as of late, as investors have just been dominated by technicals, by sentiment. I have personally been dusting off my technicals books because it's the only thing that's mattered. Valuations haven't mattered at all to this market. I think that gets a little trickier into next year, but it's been about technicals, been about momentum. If a chart's going up, investors are buying it. And that's pretty tricky for people that are focused on fundamentals and economic cycles like we are.
What's your takeaway from what we saw with Micron Technologies yesterday? So high bandwidth memory, I had to look it up. You talk about the haloed Magnificent Seven. We're moving beyond that. We're talking about the things that complement the chips that we spend so much time learning about and talking about on air here. Seems like a bright spot. Seems like something, again, beyond that core that has been such a focus over the course of this last year. Is there a lesson to take away from that in terms of breadth moving into something like this?
Yeah, I mean, it's a reminder that AI is real. It's producing productivity enhancing technology, which is really accretive for corporate earnings and for the U.S. economy. The challenge, again, is that tech is over-concentrated, it's over-loved, it's overbought at these levels. Tech kind of reminds us of it's been such a big driver for portfolios. You know, the S&P 500's compounding at 20% annualized over the past 3 years. So goes the S&P, so goes tech. It's kind of like, do you ever have one of those go-to outfits in your closet? We all have that. And
yes.
Sorry, I'm
looking
more at Lisa.
Yeah,
I think that tie,
the blue suit and tie, that's a good one.
It's kind of like the way technology stocks feel to us right now. It's like you don't need to get rid of it from your closet, but people are like, did Lisa wear that jacket already?
Hey, this is getting really
Emily.
Carry on, though.
Maybe it's getting a little worn. It's about keeping your go-to piece in your closet, but thinking about what's the next best thing in Lisa's closet for next year. So maybe it's mid-cap stocks. Maybe it's, industrial companies that are benefiting from onshoring and investment in the United States. Maybe it's healthcare names that are cheap and have great return on equity. We got to find that next thing to round out the closet without throwing away the tech stocks.
A minute ago, you'll forgive me, you sounded a lot like the president last night talking about what's to come in 2026.
Yeah.
The rewards of the one big beautiful bill, the tax incentives that are coming into effect, maybe more certainty when it comes to the economy based on the trade policy. How much of that is being communicated? We're at a moment here where we're poised to get, yes, incomplete, hard data from the federal government, but the sentiment data is still not great, shall we say. How do you look at those two things in complement?
Well, sentiment data just, again, hasn't been helpful. People are saying that things are terrible, yet consumers continue to buy. We saw that in retail sales being pretty decent. We're seeing this incredible wealth effect. That's the thing that's driving this market. You look at back-to-back 25+% returns in 23 and 24. We're on track for 15+% returns this year. That is feeding into portfolios and helping that higher end consumer who has a record amount of stock holdings right now, feeding back into the economy. So it's almost like the stock market is like the tail that's wagging the dog of the economy right now, which is a twist on the way that we used to think about things. So I think that's really helping the overall picture, even though people are saying that things aren't great.
Which is a reason why people are so focused right now on the CPI report and the idea of what the Fed's going to do with this. How much leeway do they have to actually engage in some sort of rate cutting cycle? And really the proof is going to be in how much inflationary pressure there is. You have been overweight bonds for a lot of this year. You have believed in this bond rally. Are you pulling back from that because there isn't really this lip service being given by the Fed to the financial conditions aspect of this entire story, as you were just laying out?
We're actually leaning into bonds more as rates back up. It feels right now like bonds are sort of dazed and confused. They're not acting right. You have them being kind of jerked around by what's going on in Japan right now. You've got this sort of Fed chair bingo, which Kevin is it going to be? That's impacting bond yields. You've got all sorts of dynamics, the lack of government data. Yes, we're going to get CPI, but a lot of people are just going to discount it. We're not going to get a month-over-month number because we didn't get the October data. So bonds are sort of backing up, and the bond vigilantes are coming in with concerns about the deficit and the one big beautiful bill. The bond vigilantes kind of feel like that uncle that's coming into the holiday party and disrupting the mood. Once bonds wake up, they should see bond yields move lower into next year based on the macro picture.
So you're talking about strength in the consumer, supporting a broadening out, at the same time that you're talking about bonds reclaiming their haven as some sort of defensive trade. How do both of these things work together?
Yeah, well, I didn't say the consumer was doing awesome. The top 10% of earners are doing well, and they're controlling, 50% of spending. But we've got some real cracks in the labor market here. Things are not looking great. Investors are completely brushing past this, these negative months that we've seen in terms of non-farm payrolls. We think that's important. Layoff tallies are picking up significantly. But the thing that I don't think people are talking about enough is the housing market right now. Shelter's 35% of headline CPI. It is weakening notably, not according to the BLS data. That's probably really backward looking. But if you look at Zillow, for example, home prices are flattening. They're up about 0%. Apartment List is telling us that rental prices last month just dropped the most on a month-over-month basis in 15 years. -1% on apartment listings. So what we're seeing is that shelter disinflation, we think that starts to show up into next year. Those layoff tallies we talked about, there's usually a 6 to 8 week lag in terms of when that shows up in initial jobless claims. So I think the labor market's probably weaker than it looks on the surface right now. And that shelter disinflation is also going to prompt the Fed to cut probably more than the bond market expects next year.
Emily Rowland, so good to see you. Thank you so much for being here. Emily Rowland of John Hancock Investment Management. And I will not be wearing this blazer next time that I talk to her.
I love it.
You know, my go-tos, I've got to say, went very close home in the right way. I mean, truth be told, don't we all have that, though?
Yes.
I mean, honestly, some people really enjoy the shopping thing, but maybe I'm revealing too much of myself.
Fair enough.
Anyway, let's move on. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump announcing a holiday bonus for military service members. In honor of the nation's founding year, those in the military will receive a warrior dividend, a check of $1,776 before Christmas. The president's also planning, quote, the most aggressive housing reform in American history. Those are expected to be rolled out in the new year. Meanwhile, Australia announcing sweeping new hate speech laws in the aftermath of the terror attack that saw 15 people killed at a Hanukkah celebration in Sydney. The laws include a new offense for aggravated hate speech, a new federal offense for vilifying those based on race, and making it easier for the country to refuse visas for those found spreading hate. And Washington, D.C. ramping up pressure on Caracas. President Trump ordering a blockade this week of sanctioned oil tankers going in and out of Venezuela. And according to data compiled by Bloomberg, the move is helping to push inflation in the country over 500%. This as a Chinese official expressed support for Venezuela, saying it opposes, quote, unilateral bullying. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the ECB set to make its final interest rate decision of the year. Seema Shah of Principal Asset Management with us to break down the results. After what we got from the Bank of England, a rate cut, don't expect a repeat from the ECB. It is likely to be a bit of a different tone. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. We are getting an ECB rate decision. They voted to hold rates steady, saying they're not pre-committing to any kind of rate-cutting path. They're looking at data dependency, meeting by meeting, keeping the deposit facility rate at 2%. That was the estimate. Let's get some details from that decision. Jamie Rush of Bloomberg Economics here with the results. Jamie, when you parse through all of the details, what stands out to you?
Well, I think it's more about what is it that the Guard's going to say at the press conference about the outlook for inflation, how that appears to be weakening, and what that means for interest rates. Because of course they have held interest rates steady. That was widely anticipated. The question now is, what is the next move? Is there any more room for them to cut? Do they see more space to cut, or are they going to endorse Isabel Schnabel's remarks on the executive board there? That perhaps in the future the next move could be a hike. I mean, I think those are the things we're going to be watching, looking for the inflation outlook, looking for her remarks about the near-term policy outlook.
Yeah, especially, Jamie, given the fact that they're talking about economic growth accelerating next year, raising their economic growth forecast to 1.2% for 2026 in the Eurozone from 1%. Granted, it still is 1.2%, not necessarily 2 or 3% that you see in other regions. Nonetheless, how much does that indicate this focus on inflation that you did talk about with Isabel Schnabel discussing?
Well, I mean, the key thing here is that growth, as you mentioned, is still slow. It's still potentially even below the trend growth rate of the economy, or very close to it. And of course, it's not guaranteed. What we're seeing is significant struggle for economies like Germany to gain momentum as China is slowing and its exports markets are not keeping pace. And of course, we haven't yet felt the full impact of higher tariffs, which are still feeding through to the Eurozone economy. So the outlook is, as usual, uncertain. Growth is tepid. This is an outlook where you need to be vigilant. You need to be thinking about whether you need to provide more support to the economy. So I would say that it's not a settled matter that the ECB has left rates today at 2%. There could be more to come in the year as we proceed through the year.
JB Rush of Bloomberg Economics, thank you so much for being with us. Right now, what you do see in markets is the euro just pulling back from earlier losses, almost flat with the dollar, and you are seeing muted moves across the board. What stuck out to me was the fact that 2026 inflation is now expected to be 1.9% versus a prior forecast of 1.7%. Sure, an increase, but still well below that 2% goal. David, it doesn't seem like this is screaming inflation, even as they do upgrade some of their growth forecasts.
Absolutely. And again, I think picking up on what Jamie was saying a moment ago, I think we want to get more insight into what this good place, as Christine Lagarde has called it, looks like, how she sees it shaping up over the course of these next few months. Then just going back to those comments from Ms. Bill Schneider, hard to understate how seismic the reaction to those comments was, the prospect that there could be a rate hike here in the near-term horizon. Again, her relative comfortability with that, I think, is something that we're going to want to hear more about from the president of the ECB when she speaks in a few minutes.
Yeah, let's talk to Seema Shah of Principal Asset Management, who joins us now about just that. Seema, thank you for being with us. We are seeing some forecasts here that are interesting. When you take a look at the ECB's projection for 2026, inflation, stripping out food and energy, they now see it 2.2% versus the expected 1.9%. How much is this an ECB prioritizing inflation above potentially allowing growth to truly accelerate in the euro region?
Hi, Lisa. Yeah, I think this is key. I mean, look, the ECB, unlike the Fed, is going to be solely focused on inflation. That is their mandate. So they're going to put a little bit more emphasis on that. And so to the point that, yes, growth is certainly looking a little bit stronger next year. There's been upgrades throughout the year. In fact, unlike the US, where you've seen consensus forecasts drop since the beginning of the year, European forecasts have actually increased since the beginning of the year. So there has been an improvement. Their sole focus, though, has to be on inflation, which means that they're likely to keep, at least I think Lagarde is likely to maintain a slightly hawkish narrative. But I don't think that she's likely to kind of reinforce Schnabel's comments about the next move being a hike.
Won't reinforce them, but I wonder how she addresses them effectively. So we've seen kind of the moves since those comments were made in that interview with Bloomberg. And I think just the fact that they exist, that specter kind of looms large here over the shadowing itself over the course of this meeting is significant. What does she have to say? How should she address? How do you anticipate she's going to address those comments?
Well, I think she's going to allude to the significant uncertainties that there are about the outlook. You know, as we've heard her say before, they feel like they're in a good space. Good space being that they have managed to navigate this year's various challenges with regard to trade tariffs and managed to get to a spot where they feel like growth can be stronger next year without really suffering a major inflation shock. So that's a good space. What that implies is that they have the time, the patience almost, to sit it out and see how the economy responds, how inflation responds. So if anything, we do think that Lagarde is likely just to keep the door open, not really promising any kind of forward guidance, but just talking about almost the data dependency and seeing how inflation, above anything on the economic growth or labor market side, but how inflation expectations evolve over the coming months.
You'll forgive me for going back to growth, but I heard Jamie Rush characterize it as tepid growth, and talk about all the uncertainty that Europe is facing. Certainly so many economies are facing right now. Yet if you look at all of these forecasts in aggregate, I think of OECD, IMF, World Bank, ECB now, even comments from the Federal Reserve that are rosier than they had been. There is this sense that things are improving and getting better. And I wonder how you square that with this overarching uncertainty that still looms large here. If it has to do with tariffs policy, if it has to do with fiscal spending, there's still so much that we don't know here. Given all of that, Seema, how much credence can you give to the forecast, the likes of which we see today?
Well, so the improvement in the forecast is something to do with the idea that, look, Europe hasn't been as badly hit by trade tariffs in 2025 as expected. And so some of that is expected to follow through to 2026. And some of the concerns that existed just after Liberation Day about Europe potentially being hit by a 30% trade tariff have faded, of course. So that's one thing. But I think the main reason that you've seen these upgrades to forecasts is around the fiscal stimulus, which is going to be coming through. Now, the uncertainty around that still exists in terms of what is the allocation of that fiscal spending going to be? How much does it feed through to the economy? But just the size of that fiscal stimulus is enough, I think, to lift economic growth forecast by a bit. But to your point, these are still quite small upgrades. This is still growth, which is expected to be meaningfully less in the US. So you don't want to get too excited about it. But certainly there does feel like there is a little bit more optimism than there used to be around the European story.
But is there a broader takeaway from central banks globally that see the fiscal impulse and are not shying away from either rate cuts or holding rates steady because they want to allow growth to take off? Does that make you more inclined to buy the equity side of the story than, say, the fixed income side of the story because there is this focus on growth?
Absolutely. I think the equity market story has become more attractive for a lot of places. Of course, you've got to take it into the valuation side. But the fundamental stories for a lot of these countries have improved. And you can see a significant disparity with the countries which haven't really embraced that fiscal stimulus. And the UK is a perfect example where they have continued to tighten fiscal policy. And you've seen that equity markets and general investor sentiment towards the region has deteriorated, whereas it has improved for Europe. So I think that is a key narrative. It's one that's likely to persist through 2026 as well. There could, of course, be the ramifications for the bond market and how yields are going to be performing. But at least from an equity market side, a lot of these countries do look more attractive because of that fiscal story.
The ECB just sort of underscores this narrative that's taking hold, certainly in the United States, that you can have growth without inflation. You can have a productivity-led growth that's going to allow central banks to hold rates either at neutral or even potentially keep cutting while growth is powered by the AI story. How feasible is that? Do you think that people have gotten a little bit too carried away with that narrative?
Well, I think it's a narrative which is important, but I don't think it's specifically very important for today. And I think there's two contrasting stories. For Europe, the concern isn't really around what the deflationary impact of AI is. I think the concerns on the deflation side for Europe is really around China's exports as they try and move their independence away from the US and trying to broaden their export partners. So then really flooding European markets with slightly cheaper exports could put some downward pressure on their inflation. For the US, I think the AI story is a little bit more pertinent because AI adoption has been so much more significant. But even in the US, certainly we are expecting that for 2026, for example, inflation is going to be somewhat elevated, certainly above the 3% level, but that is something that equity markets, general markets can actually absorb, and actually that central bankers can be fairly comfortable with, even if they don't specifically say that 3% is okay for the near term.
Seema Shah of Principal Asset Management, thank you so much for being with us and breaking down the ECB rate decision. I'm struck by some of these forecasts talking about growth of 2.1%, talking about inflation at 1.9% next year, and then getting concerned that maybe rates are too low and need to be hiked. I mean, it's such a different scenario heading into U.S. CPI that we're going to be getting in 5 minutes' time.
Absolutely. It's fun to look at all of these in complement because, of course, you had this Bank of England meeting on the heels of their CPI report yesterday, the way that colored their decision today or didn't, the degree to which inflation's weighing on the ECB decision. I don't know. It's fascinating to kind of again look at them all together, Lisa.
Yeah, you're looking at European growth expected to be 1.2% next year from an expected 1%. Is that a concern for inflation? In the United States, November CPI data set to cross with the expected 3% headline year-over-year number. Aaron McLaughlin of the Conference Board and Brent Schutte of Northwestern Mutual both joining us to break down the numbers. Right now, a lift to equity futures ahead of that decision. This is Bloomberg Surveillance. Good morning. 25 seconds away from that key economic data coming delayed. Nonetheless, better late than never. What we are seeing in markets is a positive lift, this expectation. Maybe we can restart this rally up about 0.5% on S&P futures. Yields decidedly lower after the ECB and Bank of England rate decisions, down 4 basis points on the 10-year to 4.12% as we do get that key inflation data coming out of the United States. Just crossing now. Let's head over to Bloomberg's Michael McKee with the numbers. Mike.
Well, better late than never is a good way to put it, Lisa, because the news is pretty good on a 2-month basis. Remember, we didn't get October CPI, and we're not going to get much out of that. 2.7% for the year-over-year move in CPI. That is down from 3% in September, the last release we got. The core CPI on a year-over-year basis falls from 3% to 2.6%. So good news on inflation. Meanwhile, good news on the job front with initial jobless claims falling to 224,000 from 237,000 revised the week prior. On a continuing basis, claims are at 1,897,000. That's up from 1,830,000. And finally, we've got the Philadelphia Fed numbers coming out now. The business outlook falls to negative 10.2 from negative 1.7. The prices paid index falls, though, to 43.6 from 56.1. Employment at 12.9 versus 6.0. So pretty much all of these numbers are better in terms of their trend. We'll break down what the CPI numbers are telling us while you break down what the markets are telling us.
Well, right now, Mike, the markets are cheering. We'll get back to you in just a second. Right now, this is a collective scream of joy in Wall Street because what you're looking at are yields substantially lower across the board on 2s, 10s, and 30s. And you're seeing equities with a lift. This is giving the green light to the Federal Reserve to cut interest rates. You can see that rally building at the front end, now down more than 3 basis points. The equity front, take a look at that rally, turbocharged, particularly for the Russell 2000. It had been up about, less than 1/3%. Now we're looking at more than a 1% gain, a similar move on the NASDAQ. S&P futures up by 0.6%. When you bleed this through the currency space, we did just get an ECB on hold. We are going to likely get a Fed that potentially could be cutting rates, which is leading to dollar weakness, as you would expect. Michael McKee, you've had a couple of seconds to look through this. Does anything stand out to you that really does seem to move the needle one way or another?
Well, one thing that is important to note about this is that October and November, there's no October data, so we don't have the month-to-month changes in most of the categories here. Some come in electronically, and looking at those, we can see that gasoline prices in November were up 3%. After falling 2.1% in the month of October. Another one we have is new vehicle prices. They were up 1/10 in October and up 2/10 in the month of November. Used cars up 7/10 in October, up just 3/10 in November. So an improvement there. Most of what we're getting is year-over-year numbers, and we can say that food, 2.6% was the increase on a annual basis there. And food at home, the grocery prices people are unhappy about, up 1.9%. So some improvement in inflation in all of these areas. I'll continue to dig into this as we try to figure out what really drove the numbers this time.
Michael McKee, thank you so much. What?
Yes, he's very fast.
It's just amazing.
Yeah,
he's absolutely fantastic.
Right.
I am curious, though, about the line items. I do think the line items are going to matter more than usual, in particular due to questions around how this was calculated, given some huge gaps in the data collection.
Yeah, and just kind of what the use or utility or veracity of all of this is, I think is going to be an open question. We'll see sort of how maybe this gets colored politically over the course of the day, given the lapse that we've had.
I'll give you a hint. I'm watching Truth Social for cut rates now.
Some reaction there. Market reaction on that one as well.
100 basis points. Aaron McLaughlin of the Conference Board joins us now for more. Aaron, how should we view this in light of everything that we've been talking about with respect to the complications around data collection, but also this look to the Fed and potentially how much of a constraint this is or isn't on them cutting further?
Well, obviously good news for consumers, and that's important. I think that we were already anticipating a possible cut in January, once the employment numbers come in early January and we have some clarity, which we didn't necessarily get with the employment numbers due to the shutdown, due to the blip over the last couple months. So I think this would certainly support that theory a little bit more. When folks are thinking, well, how many cuts are we going to get next year? I think that's the big question, is what does 2026 really look like?
Well, and also, how much are you seeing some of this disinflation, or not disinflation, but this idea that we're not seeing inflation run away? How much are you seeing that reflected in sentiment? Because this is what David was sort of referring to, this idea politically, there is a response to inflation that has been cumulative over 4 or 5 years, not necessarily a disinflation, right? So how much is this actually being felt?
Well, it's not being felt yet. So our latest consumer confidence numbers at the Conference Board, that is one of the main things that we do, has really moved sideways, after a drop in April, after Liberation Day. And then it did proceed to drop further in November. And so, and that was sort of on the heels of the government shutdown. And obviously, even within public policy and elections, the concepts around affordability are still being discussed. For American consumers, food costs more, insurance costs more, housing is still double what it was 7 years ago. And so in medical costs as well, which I don't think we spend enough time talking about. So those really big costs are still weighing on the consumer.
I think that the president's going to like the collective scream of joy in markets that you mentioned a moment ago. Yes. But I think you're getting at something really crucial here, and we saw it during the last administration. That is, the data can be good or trending better. The White House politicians can tout that fact.
Yes.
But as you well know, sentiment is so crucial here, and it's hard to kind of make that up if people aren't feeling great about where things are and where they're headed.
Right. Your average American consumer is not necessarily paying attention to today's number. And they're paying attention to what their insurance costs are, how much it costs to buy a car. We've noticed that, the average price of a new car is now over $50,000. Wow. And people used to take out 5 or 6 year loans on a new car. They're taking out 6 or 7 year loans on a new car. So it's just sort of these big decisions that consumers face, and also the small decisions at the grocery store that impact them.
Just quickly here, the labor market side of things, the jobless claims. How much can the Fed cut if we don't see any kind of pickup in layoffs or real weakness accelerate?
Well, I think that's a great question. So we don't have great data for the last couple months. We also saw that a lot of the data that we saw most recently was due to the government shutdown and due to folks in the government workforce perhaps exiting at the end of that federal year at September 30th. Where we see growth is in healthcare and in some other industries. So I think it'll be really important to sort of look underneath the job numbers to see, if we're peaking at 4.6, what's growing, what's not growing, and then that will be able to tell us more about how next year is going to be.
Erin McLaughlin of the Conference Board, thank you so much for being with us. Really appreciate it. Brent Schutte of Northwestern Mutual Wealth Management joining us now. Brent, what's your first reaction to the CPI print? How much does it color how you see investing next year and the backdrop for the Fed?
I think it certainly helps the parts of the market that you mentioned before, small caps that have been harmed by higher rates. And so if you think about the economy the past few years, it has certainly been bifurcated, as has the market. It's been narrow, both in the economy and the markets, where you've had the heavy lifting done by a few stocks tied to higher income consumers and the AI theme. And I think as you look at 2026, we do see broadening, where you see small caps doing better, where you see the average S&P stock doing better. I think it's a risk management tool, but it's also in 2026 a return enhancement tool. And so that's my first thought. My second thought is what's happening underneath in the economy when you see inflation pull back this much? How weak is actually demand? And you mentioned the labor market, which I think people are giving coastal clear because of non-farm payrolls being around 60,000, which I remind you, they were overstated by 70,000 in the data going through to March of this year. And the Federal Reserve Chair Powell mentioned he still thinks they're being overstated by 60K. So they are right around zero. And that's where I think there's some risks still that are out there.
Do you think that the market response, that if this gives the Fed the green light to cut rates, then that's positive for equities, is correct? Or do you think that it's coming more from the labor market weakness that you were just referencing?
I think it's positive for a broader set of equities. And that's where I think I come back to no one knows exactly what's going to happen in the next 6 months. I think forecasting is always difficult, but there certainly is this odd kind of mix of policy that is out there. And I think you can see that through the Federal Reserve eyes, where if you had all 19 voters voting, it would have been 12-7. And you see those dissents. And that's where I just think it's hard to figure out what's going on in the near term. But if I think about the long term, I do want to pay attention to valuation. And that's where I go back to those areas of the market that people have largely ignored. They haven't done as well because of the impact of higher rates. I think pushing forward in 2026, you have valuation with you, and you have potentially the impact of rising earnings in those parts of the market for the first time in a few years.
Brent, let's have some fun here with counterfactuals. You've opened the door, so I'm going to drive my truck right through it. I'm very curious, if we'd gotten these data before the last Fed meeting, how that conversation in the Eccles building would have been different, if at all. I mean, we talked a lot about this being an insurance cut. There were certainly a lot of questions about whether the Fed should move then or wait till January. Do the data that we've got today give you any sense that it would have the outcome would have been different last week had Fed officials gotten them?
Potentially, but I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer term phenomenon. We have not yet returned to 2%. The Fed's dot plot doesn't show it returning till 2028, which is 7 years since. And this is where I think there's concerns about what happens next year when the stimulus gets layered on, what happens next year when we get a new Federal Reserve chairman, and what happens longer term to help pay back some of that debt. And that's just where I think inflation probably still is the longer term outcome. And that's where I think the concern of some of those people on the Federal Reserve would not have gone away. Perhaps you would have swayed one or two more people. But I think there are still legitimate concerns and questions about, do we get back to 2% inflation absent some sort of economic contraction in 2026, which no one is pricing in right now.
Brent, the overlay here, of course, is this AI story. We've been tracking that day in and day out, all the ups and downs. Certainly Micron, the latest kind of chapter in that narrative. We heard policymakers engaging more with this issue of productivity, what this is going to mean for the economy or could mean for the economy going forward. How are you thinking about that in light of what you're talking about here, the kind of the persistence of inflation into 2026, the challenges facing this U.S. economy going forward?
I mean, we'll see on the productivity aspect of it. I think companies are still trying to figure out how to use it to increase employees' productivity. And I think that's a prime question as you head into 2026. I think the reality is you are starting to see it move through different parts of the economy. So it started out in the picks and shovels, I guess, and now it's moving along to companies like Micron. I eventually assume it will do much like the internet did, which is increase the productivity and efficiency of all companies who actually use it. And so that's where I think you're seeing winners and losers change. I think you will continue to see that in the future. And that's where I think anyone investing solely in AI right now or concentrating their portfolio in it is taking risks they don't need to be taking, because I think there are opportunities as it continues to shift, as it continues to spread through the economy for those companies and stocks that have previously been left out to start benefiting from it. And that's where you saw this broadening in 2000 through 2007 that occurred post kind of the concentration in 1998, 1999, which is eerily similar to today, where a few stocks did the heavy lifting for a few years. People concentrated in those, unfortunately, and then the game changed going forward, which I think is what's going to happen as you push forward into 2026 and beyond.
We're talking as we do get that broadening out, at least in the initial price action this morning. If you are just joining us, we did get the CPI print from November, the first inflation read in the United States going back to September. It was well below expectations, coming in at 2.7% year over year versus the expected 3.1%. Core CPI, stripping out energy and food costs, looking at 2.6% year over year versus the expected 3%. Then that is good news, disinflation, what we kind of would like to see. On the flip side, we didn't see initial jobless claims tick up. We actually saw them come in slightly below, the good kind of downside surprise, with 224,000 versus the 225,000 expected new jobless claims. The response in markets has been a screaming joy of success. You could see that gain right now. NASDAQ futures up 1.4%, a similar gain on the Russell 2000. Brent Schutte, do you think that this is sustainable into year end? Is this enough for what people need to see?
I think it is largely. I mean, I think the question of AI is still out there. And this is where I go back to 99, and I think the risk is similar today as it was back then, which I think was a very mild recession. What impact does the potential market have on the economy? So usually I think of the opposite. I think of the economy impacting the markets. That's why we pay so much heed to it. But this time, the markets are trading at record multiples. There is a lot of speculation that is still occurring with non-profitable tech stocks and all the other things that are out there. And this is where the economy now is dwarfed by the market, which I believe the market is now 2.3 times the economy. Is the risk there that the AI theme starts fizzling out just a bit? And that's where I think today's news is good, because I think it allows other parts of the economy potentially to have some life. But that's where I think this AI theme is incredibly important pushing forward. And we'll see what happens as we move through the day. If the market holds these gains, I think it's a positive. But certainly over the past few weeks, you've had trouble holding it based upon what's happening in crypto, what's happening in AI. Right. And that's where I still think it's a dominant theme to be seen.
Brent Schutte of Northwestern Mutual Wealth Management, thank you so much for being with us. Let's head back to Michael McHugh, who's been digging through this report for details. Mike, what do you see?
Well, I think, Lisa, the most important thing here is that we don't have the monthly numbers for almost all of the categories. This press release has a lot of blank spaces on it. So you have to look at the year-over-year changes, and we'll have to do some math to figure out maybe what it is on a month-to-month basis. But when you look at the changes in some categories, they are good news. Food at home, for example, was up 2.7% on a year-over-year basis in September, but only up 1.9% in November, in the 2 months that we had no data, that they came back down again. The goods prices, commodities, ex-food and energy, up 1.4%. That's down from 1.5%. And services up 3% over the 2 months on a year-over-year basis. That's down from up 3.5%. And finally, the BLS measure of home prices, owner's equivalent rent, up 3.4%, down from 3.8%. So all of the categories, all the major categories that people watch are down on a year-over-year basis. So it looks like in October and November we had some month-to-month declines, so some better stuff. And that's about all we can say at this point. And you asked the question earlier, does it change what the Fed might have done? I don't think so. There's not enough detail in here for them to really make any kind of decision on what it means for the future. But for right now, it is good news, and it does show unexpected progress on inflation.
Michael McKee, thank you so much, as always, for breaking it down. It does seem like markets are enjoying this. You aren't seeing, though, a huge pop in the expectation for a Fed rate cut come January. David, it seems like people are looking into the jobs picture as potentially the greater impetus to cut, given the fact that inflation still is well above that 2% target.
Yeah, still lingering there. I think that was telegraphed by the Fed chair during that meeting last week, that's likely to persist. And I think those concerns about cracks in the labor market persist here as well. Again, just looking, as Mike said, at this press report, seeing all of those empty spaces is certainly glaring. And again, I think over the course of the day, we'll learn more just sort of how this all fits together in that broader picture of inflation here in the U.S.
What a fascinating moment. We got a Bank of England rate cut going down with rates to the lowest going back to 2023. At the same time that we got an ECB 5-4 split decision to hold rates steady with concern about inflation, even though inflation is sub 2%. And we have now a Federal Reserve very much in focus to potentially cut rates because inflation didn't come in at 3%. It came in at 2.7% year over year. It just highlights how different the picture really is for everybody.
Totally disparate. It was earlier this week I was going through that long list of all the central bank announcements that we were going to get. And I think we talked about what would be interesting, what wouldn't. Certainly some interesting news today from all three of these.
Let's hear from the ECB President, Christine Lagarde, who is currently speaking at the news conference over in Europe. This is
the new